recording has started after the first 15 minutes of chat about projects that we have, because we didn't lose time in the previous 15 minutes. We talked about business in reality. So Nicola, welcome back. This is the second day in which you introduce us, let's say, to the world of business and technology transfer, and is providing us a different perspective from the ones that is typical of the scientific perspective. I stole already too many minutes to your speech, so the floor is yours, and thank you again for being here for this second part. Today is April the 7th.
Thank you, Guido. Thank you all. Good morning. And as we might say in the TV series previously, yesterday we just started introducing a little bit the concept of innovation, which is we define innovation, any invention that has a socioeconomic impact. And we define invention, a new idea, which is actually a thought of something new or unique, which is transformed into something tangible or real. So you have an idea, that idea becomes real, then you have an invention, but the invention becomes innovation if only if that matches a need in the market. And that is very important to keep in mind, because whenever we are dealing with research units for universities, etc., we should never forget that in the research world, in the science world, projects are usually run, we said, curiosity driven. So the purpose of making research is to widen the knowledge of mankind. That is the final perspective, the final purpose of any research project. But when it comes to innovation, the key point is not just enlarging the base of knowledge of mankind, but is solving problems in market or for society. So that is the final purpose. Those are two different streams which might start on the same path, but eventually they will diverge. So we are in the field and in the process of innovation, and therefore the starting point, let's say polar star, it's always a specific need in society and in the market. That is the starting point. So we have to develop something that fits those needs and solve those needs in a better way with respect to today's solution to those needs or the status quo. So that was what we defined at the very beginning. And then we introduced deep tech. Deep tech are basically all technologies which are grounded on scientific research, which can be either protected through intellectual property, or they are very difficult to be copied just because the let's say the investment and the knowledge required to reach the very same results is significant. And therefore, deep tech, which is becoming pretty much a fashionable word in these days, is it's considered under certain perspective as a new industrial revolution. So whatever comes after the digital revolution. We also understood that if we still think about the way corporations, incumbent corporations, existing corporations are innovating, and they must innovate in order to keep their revenues, their profitability steady, if not growing. That is their purpose. Otherwise, they will be basically out of business. So in order to keep their profitability, they have to go through the life cycle of their products. So anytime they have a product has a life cycle which might be different depending on the industry you're in. But nevertheless, at the end, every product will expire in terms of profitability, revenue, etc. Therefore, corporations, companies, any kind of company needs to have to introduce new products. The pace of introduction will be different depending on the industry. Of course, if you're working in the fashion industry, you have to introduce new products every now and then. But if you're working in chemicals, it may last 20 years. But still, you need those new products. And basically, the process of launching those products starts with the first analysis will be always, as I said, look into the needs in the market and the customer experience, not on technology. Technology is just a mean of solving needs and providing better customer experiences. We also understood that when it comes to deep tech, transforming deep technologies into successful products and services is not something that can be done just adding some money into the research team and spinning it off, creating just a company. That wouldn't work. And the reason why it wouldn't work is because, going back to the previous statement, as far as innovation is market-driven, not curiosity-driven, there's a point in the innovation process which we call the proof of concept, where actually you're turning 180 degrees your perspective. You're not more curiosity-driven. You start being market-driven. And you have to be market-driven, look into that specific market, that specific industry you would like to focus your business activities later on. Something which actually is not within the skills of the researcher or anyone who has been working in a research unit or university. Running a business is a completely different matter. And many businesses, they do have very, very specific do's and don'ts, rules which are not written anywhere, good practices, that are part of the experience of managers of that specific industry. So if you really want to have a successful spin-off company out of research unit, what you need is to understand the needs in the market of a specific industry and have someone on board who's able to drive that company in that specific industry. Furthermore, we also said those three elements, so the mind, so technology and bright people in technology, plus managers, plus the money, they're not enough yet. We need customers. Deep technology are primarily enabling B2B businesses. And we need launch customers. Customers willing to shape the product together with us. And shape the products, again, a process which is pretty much different with respect to technology development. Making products means satisfying customer experiences through tangible products and services, not just the core product that has to be provided, but the way we serve our customer and we give an experience in B2B that would be significant and would define whether the product is going to be successful or not. Last but not least, we need a fifth dimension. That fifth dimension is called infrastructure. Any product in B2B works if embedded, if has an impact in a more complex environment. And those complex environments, usually, they are mitigating the effect of any new feature, any new product. So I made an example of a factory. If you introduce just a new technology in a factory, then the impact you would have bottom line is not on the specific step of manufacturing that you're going to improve, but you want to see whether that improvement has an impact on the overall factory performances. If you don't have such an impact in overall factory performances, that's probably your invention, whatever bright is going to be, is not really providing a significant benefit. Now, we need complex environment, complex infrastructure to test those technologies and see whether bottom line you really have a result. And that definitely, I mean, if just sticking to InnovaMare project, think about any robotic applications anywhere. I mean, you said the example we are doing previously, so cleaning underwater a boat from any residuals which are preventing the performance of the boat, that would be completely different. First of all, depending on the size of the boat, who's running the boat, and how that process will be run, where it's going to be run, how often it has to be run, etc., and under which conditions. And something that might work just in a pool, let's say, so you take a robot and you make a test trial in a lab environment such as a pool, probably in a real environment that would be absolutely different. I can give you an example. In my experience several years ago, we invested in a company making marine conversion energy. So it was wave conversion energy. It was a wave farm located in north of Scotland. And that technology, which was called Pelamis, we were running pilot runs, which of course we have tested everything in indoor. So everything was tested on a scale model in labs, etc. But can you imagine the difference moving from a pool where you test all sea conditions and then have a winter sea storm in Scotland? with sea level above 8. So that was a tremendous test, something that you can never try unless you are there in a real environment. So that was an extreme weather condition, and we had to pass those through extreme weather condition. And we need to have full-scale prototype work in a real environment. That is exactly the same for every kind of technology. Unless you test it in a real environment, you won't have a clear understanding of the benefit that technology will bring into the market. So those 5 dimensions, which are basically more or less recalling the metaphor of launching something into deep space, tell us that creating a spin-off company out of deep tech requires more or less the 5 dimensions that are needed to launch something, a payload on space. So you need the rocket, which are technology and the great minds, and you need money, which is basically the fuel. You need management, which is the crew, a launch customer, which is the launch phase, and an infrastructure, which is the launch infrastructure of the rocket. Those are the 5 dimensions that the European Association of Research Technology Organization identified as the mandatory dimensions to create successful deep tech companies. So you do understand that whenever we come back to proof of concept, as I said, is the moment where actually we are turning 80 degrees our perspective. And without those 5 dimensions, we won't be successful later on in the market. And when it comes to understanding the how sound is a business plan, and whenever we want to address a business plan, analyze it, create it, you recall that again yesterday, we said, well, it's first of all about asking questions. We always ask questions. And the starting point is never technology, it's always the market need, of course. We want to address how sound is the market need, how relevant, and what is the perception of that need for our customers. Who are our customers, of course, is another key question. And only after we have analyzed the market need, we should ask ourselves, is our solution better than existing or future solutions? And we said there is always an alternative. So you always have a competitor, and at least the competitor you always have is the status quo. So customers would always have the choice between purchasing or not purchasing something. Only after we make those analyses, we move into the market analysis in terms of size, growth, etc. And then we end up into something which is, again, pretty much a complex phase of the business plan, that is understanding the revenue model. I mean, in your case, are you selling a robot? Are you selling services? Are you selling consumables? What are you really selling? Which doesn't mean that eventually the overall mission profile would be different, but you have to understand what your customers are willing to pay for, and their willingness to pay depends on the kind of service and product, and of course the way you make money might be completely different. And we make several examples, such as, again, in medical devices, if you have a heavy-duty medical device, which is very expensive, and hospitals wouldn't afford to purchase it, you give it for free, and you let hospital pay for every treatment through purchasing related consumables. So that was in a not really a nutshell, but at least in a 10 minutes summary, what we have seen yesterday. Now, moving forward, what we're going to see today is more on the financing side. Okay, so Guido, your previous question said, where do I find the money? Well, probably, I'm not going to tell you exactly where you find them, but I will tell you a little bit what are the different options you might have. And more relevant, again, I think it was Fausto's question yesterday, when he asked me, but is venture capital interested in investing in a very low technology readiness level? And my answer was, not at all. This is not the business of venture capital. So you would also understand that there are different phases, different financial instruments available, different financial providers. We'll go through them. We will then, of course, analyze how venture capital fund works, which is very peculiar. And going back to your specific project, interesting, the business model of venture capital comes from the sea. Okay, now I will not tell you right now why I'm saying that, but it's very interesting. And then we move forward. I will show you some figures. about the world of investments for startup investments all around the world, from Italy, Europe, and the US, and ending up with some information how we can evaluate a startup company, which is one of the most common questions anytime that we make investments. People are asking us about how much you value a company, et cetera, which is a significant guess, but we'll go through this. So I will be sharing the screen. Okay. So it's almost time for a break, but we can start.
Yeah.
So startup financing tool. Now, the first concept here is, remember that we talk about product life cycle, but also startups have a life cycle. So they have different phases in the life of a startup, and in each phase we have different deliverables. So the first step, the first phase in a startup life cycle is the idea phase. What's the idea phase? The startup might be or might not be already incorporated. What you do here is that you had just an idea. Maybe you had, and then you have to transform that idea into something that might become a business. So we are usually in the POC level. So out of that idea, what you have to deliver after the idea is not just the invention, so the tangible realization of your idea, such as the alpha prototype, but you must have a clearer identification of your final market. I was to Francesca's previous question. So before you incorporate, have a clear understanding of what your market, your target market will be. You have to draft the business model, how you reach that market. I said it's going to be a draft. It's not a business plan, it's a draft. We would have figures that are really rule of thumb, but we need a better understanding on how we think we can move forward. And we should also start making an estimation of the resources needed to get into that market, both in terms of human. When I say human resources, not just the full-time equivalent people, but which kind of skills do we need within our team? Who should we be looking for in terms of advisory board, if you're looking for top managers, or in terms of execution team, et cetera, and how much it would be required to be invested in order to move our idea forward. So those are the qualitative deliverables that we should expect out of the idea phase. Second step, then we start working around the final prototype, or the, let's say, the minimum viable product. So we have to test our product and service together with launch customers. So we had an alpha prototype, we turned that prototype into something that is very close to the final one, the one that is going to be industrialized. We have to test it together with customers. We have to collect the feedback from our customers. Most probably, this prototype will be shaped together with customers. That is, in B2B, pretty much the role of the launch customer or the risk-sharing partner. That's very common in aerospace, but I think it's very common also in marine. So you have a launch customer. The launch customer has the benefit of shaping a product in a way that better serves its need. On the other side, of course, the launch customer runs the risk that there will be some problems in the product as far as he's the first to test the product. Then once you have that feedback from your customers, now you are in a better shape to go through a more detailed and precise industrial and financial plan. You should end up at this phase with a full setup of your core team. So we should know out of this phase who's going to be part of the core team, and the core team should be ready to move forward the next step. The next step is the market launch. We have a prototype which was almost ready to be industrialized. Now it's time to turn that prototype into the final product. We have to scale up our operations so that we will be ready to get into the market. We have to start making significant marketing activities and prepare the market launch. And of course, our structure, I mean, in terms of people, would be almost the definite one, because you enter the market if and only if your company is fully ready to serve that market. So you would need everyone on board before you get into the market. Don't wait to get into the market and then hire people, because that would be too late. People need time to understand the product, need time to understand the organization. And if you don't have people, you will be overwhelmed by all the activities required to launch something into the market. If you're overwhelmed, you don't serve your customers properly. And even if you're able to reach the market with the right product, your overall service towards customers will be weak, and you would probably be out of business soon after the market launch. So market launch is the third phase, followed by the fourth phase, which I call the scale-up. Any good startup company, especially if you're willing to attract investors, must have a global perspective. We don't serve local customers only. I mean, this is fine. I mean, from an entrepreneurial perspective, you don't need, it's not compulsory to have a company that goes globally in a short time. But if you really want to attract investors, and especially financial investors, you must have a global perspective. And the global perspective is something that you can reach in the scale-up phase. The scale-up phase is the phase when actually after you have launched the market, in the initial market, maybe you make a selection if around 1 to 3 different international markets, and then decide to get global. Getting global requires significant investments, and you need local branches, you need distributors, you need local marketing. Don't think that the globalization is something that standardizes everything everywhere. Reality is that every country is different, every culture is different, and therefore you need to adjust a little bit the message, the marketing activities, if not even the product, in order to serve a specific market in a different way. Then you need a global supply chain. You need global certifications. Every business, not just medical device, every business is certified. So I'll make an example. We have within our portfolio company that has developed this platform I told you yesterday for augmented reality in maintenance and inspection. That platform is certified for explosive environments, so it's Artex 1 certified. And as far as it serves industrial customers, needs to go through the certification of different countries. An example, one of the most complex certifications that we had to deal with was the Russian one. And of course, if you're working in oil and gas, you can't have the Russian market. But we need to spend a significant amount of time of our engineering and quality team in order to prepare the whole documentation and the whole test to pass the Russian certification, which was different with respect to the US certification, et cetera, et cetera. So even in businesses which are not perceived to be very heavy in terms of compliance to certification, still every business has a certification. So you want to scale up, you must have this structure, the execution plan, and the supply chain ready to serve global markets. And if you have attracted financial investors, the scale-up phase is the phase that precedes the exit, the de-investment of your financial investor. And remember, this is very important. Any financial investor will give you money if and only if they understand there will be a chance to have that money back, actually to have more money back out of the sales of their investments. So the scale-up phase is the phase where actually planning the exit or the de-investment opportunity is mandatory if you want to attract financial investors. So those are the 4 main stages in a startup life cycle. And as you might understand, look at those deliverables. You have in front of you 4 completely different companies. The last one is basically a global company. You might have hundreds of people working for you, while the first company in the idea stage is maybe just 5 people with a lab and a narrow prototype of that product. So you see, that is the process where actually the shape of the company changes completely. So as far as the shape of the company changes completely, then also the way you attract investors and the kind of investors that are willing to invest in the company would be different phase by phase. Now, let's have an analysis, a better analysis in terms of revenue, costs, and investments for each of these phases. Now, let's start with sales. The first two stages, in the idea and the minimal viable product, you don't have any sales. So your company will have 0 sales. Your balance sheet, your P&L, the top line will be 0. So your company is just a cash-burning company. It's just not even unprofitable. We call it a pre-revenue company. Would start seeing some sales in the market launch phase. This is very critical because the metric of those sales, the trend of those sales will be the trend that investors will look at in order to understand what is going to be the reaction of your target market with respect to your product. And only once you scale up, sales would become significant. So sales are a metric working primarily in the market launch phase and the scale up one, but you don't have sales in the idea and the minimal viable product stage. Marketing investments. Well, marketing investments, although they are of course very high in the market launch phase and the scale up one, so and especially in the scale up, marketing investments are huge because you have to scale up globally and you need significant investments everywhere. But don't forget that you must make investments in marketing still at the idea, at the MVP phase. If you recall yesterday, we talked a little bit about POC and the way we leverage intellectual property in POC. And I said, well, intellectual property is not just patenting something. You have to think about intellectual property in a broader perspective. And one of the key elements of that broader perspective is, an example, brand. Brand reputation, the image of your company is significant. You never have to tell to your customers, especially in B2B, that you are a startup company. Incumbents, corporations do not like to have suppliers perceived as startup because a startup company is by definition unstable and unreliable. What you need to be is to be perceived, yes, as a small company, but yet a sound company, a robust company. So, and in order to do that, marketing in terms of brand, image, etc., is a mandatory investment, even at the idea stage. Otherwise, you won't even be able to attract launch customer for the MVP testing. HR, HR costs, so the level of people you would have in your company. Well, people are usually anticipating, the size of your team anticipates the phase. So when you are at the end of the MVP phase, you should have almost all the team required to launch into the market. Hiring people takes time. Once people are onboarded, they don't just become effective the day after. They need time to understand where they have landed. They need time to understand the business they are in, etc., etc. So remember that the size of your team anticipates the size of your business. So, and there is no better investment in any startup company than hiring the right people. I always said to my entrepreneurs, if you really want to be the best entrepreneur, the one that beats everyone else, your primary goal as an entrepreneur is to hire people who are better than you are, who are smarter than you are. Because if you have a team of people that you manage made of people smarter than you, your company will be successful. If you want to be the only one smart in the company, then that is definitely the right path towards a failure. So HR is the best investment you can do in any startup company. Then operations, and when I say operations, I mean everything related to industrialization, supply chain, manufacturing, etc. The investments in operation become significant definitely at the market launch here because we have to invest in tools, manufacturing facility, etc., etc., etc. but they are significant in the scale-up phase as well, because probably you have to stretch your supply chain and logistics, but you will also have some important investments once you are in the prototyping phase, because here again you anticipate a little bit some manufacturing tools which will be required later on. Last but not least, research and development. Well, this is pretty much intuitive. Research and development is significant in the first two steps. You keep on doing pretty much significant R&D investments even once you have launched in the market, probably because your product portfolio needs to be enlarged, but you never stop doing investments in R&D. Otherwise, we will be out of business in 5 years' time. And investors don't like companies going out of business in 5 years' time. You're creating companies, not just meteorites. And your goal is to have a portfolio of products which are basically leveraging your technological platform, and you have to introduce new products depending on the industry you're in, but at least every year you should have some new products, new extension of the product entering the market. If you don't have that, you will probably be out of business. So never stop making research and development, even once you have scaled up with your company. So based on those previous information, let's have a look to the key financial metrics of a startup company. So we said in terms of turnover, turnover was almost zero up to the market launch. And then you see some good turnover in the scale-up phase. Market launch usually, the threshold of turnover between the market launch and the scale-up is in the range of 2 to 5 million. So once you have reached the level of 2 million, then we might say that 5 million, then we might say that you have launched properly a product into the market. That happens in almost every industry. Which again doesn't mean that if you are creating a company that with an early turnover of a couple of millions that stays there forever is a bad company. It can be a wonderful company, but in the eyes of an investor, we are looking for companies able to create a turnover which is in the range of dozens of millions, if not hundreds of millions. If we don't have that perspective, it will be pretty hard to attract financial investors. Profitability. Well, profitability, you will see some profitability only at the, let's say, the last steps of the scale-up phase. At the very beginning, you don't have turnover, and therefore you always have cost, just cost, and that's pretty much intuitive. But even once you start having some revenue lines in the market launch phase, still your cost structure will be significant. Not, of course, in terms of variable cost, while, of course, variable cost will be decreasing as you scale up, and that's very common, and we're talking about economies of scales, but the cost structure of your headcounts, for example, the cost structure of all the general administrative staff, etc., that will be significant because it anticipates the scale-up phase of your company. So companies, usually startup companies, become profitable at the end of the scale-up. If you recall some digital giants, for example, it was both for Facebook or Twitter, you should recall that whenever they went through an IPO, and they were already huge in terms of valuation and turnover, none of them was profitable. They had negative profits. So it's not surprising that even an industrial company, something working on hardware, won't be profitable until it reaches a scale-up phase. Last but not least, cash. There is a significant difference between profitability and cash. And one of the main reasons driving the difference between cash and profitability is that, well, profitability measures how much money you made, taking out all your costs with respect to the turnover. But if you add, on example, investments, those investments are not something that you see in profitability, but they do require cash. So if I buy a new manufacturing facility, that cash won't be seen at the P&L level, so it won't be seen at the profit and loss level, but would definitely have a cash absorption. Marketing investments probably you don't put those marketing investments between costs because they are investment, but still they absorb a significant amount of cash. So it's not surprising that companies in the scale-up phase would need significant amount of investment, even in the scale-up one. You heard about those big rounds. Now they're becoming fashionable, rounds of 100 millions, we call them mega rounds. Those mega rounds are there because big companies, even in the scale-up, they require much cash to consolidate their presence, consolidate their business model, and become profitable even from a cash point of view. So cash is always needed by startup companies willing to grow in global market. And the cash is the variable driving your need for investments, your need for cash. Without cash, if you recall the metrics I have shared yesterday, well, cash is the second cause for abortion of a startup, the second cause for failure of a startup, together with not the right team and not clear market need. So cash is the variable you always have to keep under control, and is the language you will be speaking with prospective investors. Now, the way you can have cash into your company, there are two ways of attracting cash. One way is you ask for a loan, and the second way you ask for risk capital. Now, let's have a look. Please.
Nicola, if I can interrupt, we have a very vivid discussion that is going on in parallel in the chat that is super interesting, because I know that you are looking at the screen, so you are missing the let's say everything that is going on, because everything started actually that let's say a provocation that I sent there, that I said some minutes ago. Later, I would like to discuss the issue of long-term cash-burning businesses like Spotify, that is a global leader, world leader, and that is not producing any kind of profit at all. Then I also downloaded the very last financials from Tesla, and saw that for the very first time in its history, Tesla Motors became profitable in 2020, and that was the very first time. And so with Fausto, Matteo, and others, and also Valeria, so we were thinking, how is it possible that, especially nowadays, we see these, let's still call them startups, that in the long term, in the scale-up phase, they are still burning a lot of cash, and we don't see actually much profitability, like they are not able to reach the break-even point, and like they are not able to find the right business model for being profitable. And I think that Fausto was asking, maybe they have to reach the break-even point because they are not still, at the level of the full scalability. But actually, if you think at Spotify is the global leader, so it already reached the scalability, but it is still a money burner. So how can we explain the fact that nowadays we see so many global startups that are burning cash, not producing a coin, but receiving a lot of finance, receiving a lot of investments, and but not really, if they were, let's say, evaluated with the old metrics, they will be already, dead, but they are still alive and kicking. Very long question, very complex, but I hope that was clear.
Well, I can't speak precisely for every case, because every case might be different, and no one knows exactly what was the plan of Spotify, what Spotify told to their investors, what was in their business plan, and the same is for Tesla. Okay, so I can't speak for every specific case. But still, my perspective is we have noticed in recent years, and when I say recent years, I would say at least in the last 5 years, something which recalls me pretty much speculation in venture capital. Venture capital industry has changed dramatically its shape. Is considered nowadays a real asset class. It's a financial asset class. It was interesting. Last year there was an interview. I forgot the name. He actually is a American French person. He invented venture capital in 1946. He invented the first venture capital company, and he is also one of the founders of INSEAD. And in this interview made by the Alumni Association of INSEAD, he said, well, you know, in my origin, my initial business was to support my portfolio companies actively, looking for their growth, profitability, helping them finding the right customers, etc. And that was my business. That was the business I had in mind when I started doing the job of venture capitalist. But nowadays, whenever I heard the word investment asset, financial asset, then this pretty much recalls me speculation. And as a matter of fact, in several conversations I had with expert people in the US, those coming from the big universities dealing with the significant spin-off companies, they always told me, you know, venture capitalists, they are financial investors with basically no knowledge of where they're investing. Of course, they are the leaders, such as Sequoia, the big names. And those leaders are setting the trends, and everyone is following them. And if you talk with other venture capitalists, they always tell you, well, you know, this is very fashionable. That's why I invest in it, because at the end of the day, as far as it is fashionable, there will be someone willing to buy something. So whenever there is not a rational, an economic rationale in doing investment, but just a sentiment rationale in running such an investment, this is where I think that we have speculation. It is not surprising that in recent years, I was saying, we have noticed that several asset classes have been starting doing, let's say, semi-venture capital investments, such as hedge funds. In the last years, many hedge funds started doing investment in the latest phase of venture capital. In 2020, we saw an explosion of special purpose acquisition vehicles dedicated to venture-backed companies. What is basically the situation worldwide? The situation worldwide from a financial point of view is that there is an enormous amount of liquidity which is blocked. And whenever you have such an enormous amount of liquidity, money goes where fashion goes. And those investments are fashionable. And you look at how venture capitalists are acting. They're just people working in communicating themselves. It's a fashion. And we are measuring, even at political level, the benefit of venture capital in terms of the amount of money that is invested in a company. Nobody tells about how much money a company makes. Nobody tells us how many people have been employed. What was the impact on GDP? What was the impact of society? We are just... so it's a business that is actually becoming pretty much close to a circus. I always call it, I mean, joking, being part of it, a circus. And the recent trends confirm me that it's a circus. The concept of unicorns, those big names valued billions and billions, the reality is, and there was a research made by PitchBook. PitchBook made a research in the investment contracts of those unicorns. Interesting, while the valuation, let's say, the price paid for those companies were huge, but that was just the nominal price. Then if you look into the clauses of the investment, which are usually confidential and which are not shared, then you discover that there are clauses that basically reduce dramatically the real price of the investment. In some cases, in an order of magnitude. So something that was valued 2 billions, reality is it was paid 300 millions. But the face value is 2 billions. For many reasons. First of all, the reason that if you had such an asset class in your portfolio, you want to keep the nominal value high, because this is where your metrics are measured. So the point is, there is definitely too much speculation. There is definitely, I refer to bedtime stories. Bedtime stories where you have nice guys that decide to turn out of their university studies when they are 22, they get into a garage, then there is a gentleman that just give them a couple of millions because they're fancy, and 3 years later, they are just ringing the bell in Wall Street, and they become billionaires. And those are fake stories. I'll show you later on the real figures. The world is different. The real world is different. And real world is different in terms of the time required to grow a company, the values of investments, the real money that you make, etc. So your point, I agree with your point, is significant. Okay, Tesla, it's definitely a very nice car, very long term. I mean, think about it. It's a new automotive company. Creating from scratch a new automotive company is significant. Okay, so I wouldn't even call that a startup company. Then we like it. It's fancy. It's electric car. I mean, you don't create Nissan or Toyota from scratch in a night. Okay, so doesn't surprise me this company is not yet profitable. It takes much longer time. But what definitely surprised me is to see business models which are not there in the digital world, but where everyone needs to keep on investing because it's fancy, it's fashionable, and because nobody can afford to lose those investments. Because there are also mutual interest among investors. So you support my company, I will support yours. So we are all happy about this. Until we reach a point where maybe the bubble explodes, and we have seen it already. But we're not there yet because there is a huge liquidity around. I think there was a question from Fausto.
Yes, no, just a quick comment. Tesla, I think it's still on the scale-up phase because they're still buying and trying to integrate the supply chain and getting the whole production from the battery level to the whole car. So they're probably trying still to consolidate and expand before focus on the profits. That's probably one of the issues.
Absolutely. And by the way, I mean, we are talking about a brand new car manufacturer. So as I said, I'm not surprising to see it taking a significant long time to get positive. It's like, I mean, I think about Italy. Okay, we don't have those huge runs in Italy, but if I'm not wrong, on example, think about Italo Treno, which is the private high-speed rail operator, which was invented from scratch, and it was just an operator. I mean, so they're not train manufacturers, and the investment was in the range of some hundreds of millions. I don't think they're yet profitable for definitely after the COVID crisis, not at all. But I mean, you are starting a new rail operator. This is namely a startup company from a certain perspective, but it takes time to be on the market, to become profitable, etc. And that doesn't surprise. This is an industrial investment. It's financial, but also an industrial investment. And Tesla, such as and SpaceX, for example, they have visionary entrepreneurs and they're making a long-lasting investment, industrial investment. Fine, but let's stop talking about startup companies. Think about Amazon. Amazon, at the end of the day, it's an enormous Walmart with significant logistics. And profitability from Amazon doesn't come from logistics and their e-commerce. Profitability comes from the web services, which they eventually discover later on that running that logistics through that e-commerce would require setting up significant data centers. And then they started saying, well, selling data is much more profitable than just selling good. But you have the beauty as a reseller of data that you know all the customer experience, you trace customer profile, you know what they're purchasing, and the value of that data is significant. And if you also become a data manager, a third-party data manager, this is where your money comes from. But at the end of the day, Amazon definitely has changed our life, but at the end is still moving goods from one part to another in a very efficient and effective way. But again, it's an industrial and I would say from a certain point of view, even old economy business, and not surprising that now they have labor problems, etc., such as Uber. Uber is not a technical revolution. Uber is just a smart way of renting a car with a driver, okay? I don't know whether I answer your point, Fausto.
Yes, I agree. And especially on Uber is the same thing. It's just providing a service and they're trying to disrupt the market. And now you see other companies, traditional taxi companies, going towards the Uber model, actually.
Absolutely.
I personally, Nicola, agree with you on the fact that Tesla is a company that from a financial point of view, let's say, I don't like much. I don't like much, let's say, all the narrative around Tesla, but I must confess that I admire a company that was really able to change an entire industry from a market share that I think that some years ago when they presented the Model 3, that was the first one that I think you could pre-order by paying 3,000 euros, something that looked like a sales of a new iPad, let's say. And they were able actually to change an entire industry and to push an entire industry in another direction from a market share of close to zero, let's say, really close to zero. So chapeau for doing that. But yeah, as you said, sometimes it's a matter of having patience, because in the case of Tesla, it was about having a lot of patience. But sometimes it is also a fact that all these businesses nowadays are too big or too much finance to fail. So no, I reported the quotation from you. Nobody can afford to lose such investments that they have made in such companies. And so these companies are growing, are absorbing further investments, but of course there will be, let's say, an end point, because this is a typical shape of a bubble that is growing, and that sooner or later bubbles explode.
I agree, but and honestly, whenever I see a new Tesla, a SpaceX, or even a new Amazon getting on the market with those, let's say, visionary ideas and massive industrial impact, that I would say it's an interesting industrial investment. Okay, because at the end of the day, whether they're right or wrong, but they open new industries. What I found pretty much part of the bubble and of bad narrative around startups are all those businesses, usually consumer businesses, which are actually unethical, although they're published as very ethical, and the fantastic impact of digital transformation. Think about all the food delivery stuff, all those food apps, where actually you're just promoting slavery, and that is just, I mean, now it emerged dramatically during the COVID. All those businesses which are now becoming very funded, attracting a significant amount of money, even in Italy, which are named under the prop tech business. Prop tech is all about a digital interface for real estate. So we are going back to the mortars and bricks, where the money usually goes in every situation. So even if you just put a layer of intermediaries which are digital, but still it's mortar and bricks, and this is where the money goes. And one of the biggest failures during the pandemic in the US was a unicorn, and that unicorn was actually a chain of toast makers. Now, someone should tell me, is really the world looking for a new chain of toast makers in the US, which was valued more than some billions? And of course they failed, because after the pandemic they have to close several shops. So again, and all that narrative around unicorns and the impact of fantastic investments, reality is that sometimes you're just painting of novelty something that is very traditional, and honestly doesn't deserve even the name of innovation. It's just pure financial speculation, or even good financial speculation, but still we are in the world of financial speculation, not in the world of industrial growth and economic impact.
Okay, there was an article interesting on, I think it was Spanish or French. It is fast expanding in Europe, a prop tech company. I don't remember the name, that is related to rocket and something. And maybe if I find the link, I will send you the link, because it is a really interesting case of a business that is fast, let's say, fast growing. According to some, a potential disruptor. According to others, let's say a big question mark. Nicola, it is 10:10. It is time
10:10.
for 10:10. It's time for a coffee. 10:10 is also the time that is depicted in every watch that is sold, because it has the shape of a smile, and in terms of marketing, it works well. And so we can interrupt for an espresso and be here at 10:20. What do you think?
10:20. Great. See you
No,
soon.
normally we make 10 or 15 minutes. I don't remember.
10 minutes.
10. Okay, so let's see you back in 10:20. In 10
10:20.
10 minutes.
10:20.
10:20.
In 10 minutes.
Okay.
See you soon.
Ciao. Nicola, at 1 p.m. I won't be able to close the session because at 1 p.m. I have a meeting with a company for a project that is ongoing. So maybe I will ask Grazia to, let's say, to end the session. And,
yes, of course.
No problem, Guido.
Okay, so nice that actually you're. We know we are slowing down a little bit, Nicola, but actually it is nice, in my opinion, that from these slides, some discussion, starts, originates, and develop, because that also allows us to understand a little bit better what is happening around. Today we are literally surrounded by news about new startups that are disrupting everything. We read the term disruption at least 20 times a day in every website, newspaper. We also forgot what was the original name of the term disruptor by Clayton Christensen, but this is just a parenthesis, let's say, academic parenthesis, that was completely different from the use that we do today of the disruption. But actually, what is true is that we see new businesses, and probably also our expectations of change, in my a little bit higher than what the reality is showing us, because at the end we see many industries that are still quite conservative, but not because they don't want to change, but because even process of changes in the business models requires a lot of time. Sometimes there are lock-in effects going on. There are past investments in technologies that still needs to be repaid, and so that slow down, let's say, the transition to the digital world in many industries. At least this is the impression that I have. And also let's say the slow down a little bit the speed of the digital revolution, even if of course it is a revolution that is taking place and will take place in any industry. But sometimes I think that let's say in the news we see a reality that actually sometimes we struggle to observe in our, let's say, daily life, but that one day of course we will observe. I don't know what you think.
First of all, once you were talking about the term disruptive, I don't have time, but I have a graph which is interesting, because that shows the number of times the word disruption or disruptive is included in publications. And that graph, it looks like the Moore's law. So in the last 10 years, we had such a significant growth in the use of term disruption that is becoming, it is actually disruptive not to use anymore the name disruption or disruptive or whatever, okay? So, and I would say from a communication point of view, every journalist nowadays, in some countries like ours more than other countries, like the UK, the way journalists are reporting news is much more on having, I mean, the big title every day. If you don't have the big story, well, you invent it. And sometimes the normal life doesn't make a story, and therefore we like to invent story or to tell stories or create stories around something that is not really at all reality. That is my sad observation around many journalists writing about our word or any other words. I mean, I recall and sometimes they make huge mistakes. For example, I remember one article related to one of my first funds, and actually I discovered that I was managing something like 60 billions. So it was fantastic to know that I had a 60 billions fund, which is basically 3 times the financial, let's say the financial leverage of the Italian government, usually the one that is approved every fall. Yeah. But so there's much noise around innovation, disruption, etc., but reality is pretty much different. And I would be very, very happy to show some figures around it later on.
Okay.
And then we can have a better understanding what the real world is all about. Going back to our let's say to our point, we said we need to support financially the growth of our companies, and definitely it's really on the long term. If you want to have an impact, especially in deep tech, that would be much on the long term. Now, there are two ways to have resources from a financial point of view. The first way is you look for a loan. Now, the way loans are working, let's make an example of a bank loan. This is an imprecise example, but it gives you more or less the idea. So if you ask for, let's say you look for 100 euros, okay, and you look for 100 euros and you look for a loan, what you get is, if you knock at the door of a bank, the bank gives you 100, but in return, they want to have that 100 being returned, let's say in 5 years, so 20 every year. And on top of this, they're looking for interest. So they ask you to pay something like 5% interest every year. So at the end of the loan, you got that 100. That 100 was required for making some investments, and then you smoothly return that 100 as time passes by in the next 5 years, plus of course 5% interest every year. I said this is very imprecise, but just for the purpose of understanding. So at the end of it, the advantage for you is that you had that 100 which was required to make investments and of course to have your company growth, become profitable, and then reimbursing later on that loan. From the bank perspective, that bank gave you 100 and had a return of 125. Now, the way a bank loan works is that you, as an issuer of a loan, you give that loan if and only if you have a significant high certainty that that loan will be reimbursed. That's very common, that usually what banks are asking to companies are guarantees. So they want to have guarantees, they say collateral, so that whenever the company through its operation is not anymore able to fulfill the reimbursement of the cap of the loan and the reimbursement, and is able to pay the interest, then the bank is entitled to leverage on the collateral, leverage on the guarantees, and at least return the loan on his account. So basically there is no risk associated to a loan. You are willing to give a loan if and only if there is almost a certainty that the loan will be reimbursed and you're not going to have a loss. So this is how it works. You give 100 and you know that based on that 100 that was given, if you're a loan issuer, you will see a return of 125 in the next 5 years. That will be basically split to 25 every year, 20 returning the loan and 5 as payment of interest. Then there is risk capital. Risk capital means that the company is looking for 100. And that 100 is issued not in the shape of a loan, but in the shape of equity. So someone gives 100 to a company in exchange of a certain portion of equity. How is that 100 returned? That is pretty much unknown, because we don't know how much money will be returned. So how much money that equity that we pay 100 will be valued, and when and by whom is going to be valued at the exit point. So you see there is a significant difference between issuing a loan, which of course needs to be paid with interest, but let's say is going to be issued if and only if there is a high certainty of being returned, and a risk capital where actually equity is paid at the beginning, the money flows into the company, but eventually the investor doesn't know how much and when and by whom is going to be his investment is going to be returned. If you just try to compare the risk associated to a bank loan and the venture capital risk, And now the graph you see on the left is the debt loss forecast per company size. The source is the Italian Bank Association. As you see, of course the risk associated to a bank loan depends on the size of the company. Usually, big companies are more have a less risk with respect to micro companies. Now, as of the forecast of 2020 figures, big companies had a failure rate, which means they were not returning the loan that was issued to them in 1.2% of cases, with respect to 2.2% of cases for micro companies. So it's actually the double, more or less the double. So micro companies have a risk associated to a bank loan, which is the double of a big company. But still, we are in the range of 2.2%. The highest risk bank is running and not seeing the loan they issue being returned is in the range of 2.2% of cases for micro companies. If we go back to venture capital, this was an analysis made by INSEAD. In INSEAD, basically, they understood that in 65% of cases, portfolio companies didn't return what was invested in them by venture capitalists. So actually, the ratio of risk between the worst case in the Italian scenario for a bank loan and the venture capital risk is about 27 times higher. So if you consider that proxy, you might understand easily that this is an example why banks are not giving loans to startup companies, because the risk associated to them is too high, 65% probability of failure. But while vice versa, you can easily understand that whenever you're looking for an equity investment, based on the risk such an equity investment is running, then the perspective of a return to investment is definitely much, much higher than the 5% I gave you as an example for a bank loan. So it's not surprising that you're asking for 3 times, 4 times, 10 times the investment, because the risk you're running is on average 27 times higher than the risk a bank is running whenever issuing a loan. Now, let's get on the same floor in terms of terminology. You recall I divided the life cycle of a startup company in 4 different stages: the idea, the minimum viable product, the market launch, and the scale-up phase. Now, for each of those phases, there is also very specific terminology in terms of the round of investment. So when you have an investment, a risk capital investment in a company, depending on when that investment is performed, then you give a different name. In the US, we usually refer to pre-seed investments for all those investments which have been performed when the company is in the idea stage. Then we talk about seed investment when a company is in the minimum viable product stage. A round investment once a company reaches the market launch. And then after the A round, whatever is the next investment round is basically just a letter that increases following the alphabet. So you have B, C, D, E, etc., round. I've seen also once the Q round in a company. In Europe, we usually refer, and this is an example, the European Investment Fund terminology. We refer, as for the US, for pre-seed in the idea phase, seed in the minimum viable product phase, but then we don't call them A round, we call them startup round for all those companies which are in the market launch phase. So it's interesting, anytime that you hear the word I make the startup round means that an investor is investing in a company that has already launched in the market. And then we refer generically to later stage for all those rounds which are executed in the scale-up phase. Early stage in Europe refers to all the rounds between the pre-seed and the startup phase, and then we refer to later stage. So this is basically the terminology that we refer to whenever talking about investments. Now,
Nicola, normally the A round, B round, C round, normally they scale up also in terms of money invested, right? So 1
That's
million,
correct.
2 million, 4 million, and so on and so forth.
That's usually correct. Not often, because it could be that some as far as they're just indicating the successor round, could be that, an example, you have a D round which is bigger than an E round, and the E round was there just because you need extra cash, which was not foreseen in the D round. Okay. But usually they are growing up in terms of size. There is also a rule of thumb that actually you usually have a day investment after the C round. So it's not very common to see D rounds. But again, we're talking about the average of the chicken in terms of statistics. We were referring to venture capital. Everybody talks about venture capital as the tool for supporting innovation. Now, venture capital is a very, very specific investment tool, and venture capital refers only, venture capital funds, they do only work from the A round onward. This is where venture capitalists are investing. So don't look for a venture capitalist for the pre-seed or a seed fund. If you have a venture capital fund, then they will be asking you, in simple terms, let me see your figures. Let me see your turnover. I want to invest in you if and only if you have already 2 million turnover, 5 million turnover, and this is my starting point. Then I will be following up. And it's not surprising to see, I don't have the figures, but you can look, exactly, that's the point. I was looking to the chat. So it's nowadays, there's a trend in venture capital where the majority of funds is getting bigger and bigger and is focusing just on the scale-up phase. So even the A round is becoming not really attractive for venture capitalists. But this is, pretty much comprehensible. If you're becoming an asset class and you want to have significant financial returns, the best way to have very good financial returns is to invest a lot of money where the risk is less. So where do we invest a lot of money with a less risk? Just in the scale-up phase. Simple equation. You get there and you make money. You get early stage, it's pretty much more difficult to make money. So this is where venture capital funds are focusing. Doesn't mean that there are the only funds you should be looking at, because an example, there are seed funds. So there are still closed funds, they are investment funds, and their strategy is to make investment in the seed up to the A round phase. And then there are technology transfer funds like ours, and our fund, for example, invests from the pre-seed up to the A round. So if you refer to generically venture capital, well, venture capital is later stage, market A round, B round, C round, not before. Then there are some peculiar funds that are focusing on seed phase and A round. Those are called seed funds. And other funds, even more peculiar, such as technology transfer fund, which objective is just make investments from whatever comes out of scientific discoveries. And there are very, very few funds. In Europe, there are not more than 30, 35 funds which have been established for technology transfer in the last 10 years. And their primary objective is to make investments from the idea, from pre-seed onwards. And this is the world of investment funds. But investment funds are not the only way of looking for risk capital. There's a whole world of what we call informal investors that are investing in the companies from the pre-seed onwards. And namely, we refer to informal investor, usually we call them the 3F+1. I will explain to you what that means. Then you have business angels, you might have heard about them, and equity crowdfunding, which is pretty much a novelty and might be interested for several prospective spin-off companies. And you see that actually each of those instruments is usually used in a different stage of the startup life cycle. So again, if you're looking for an investor, don't just look for a venture capital fund, but you have to think precisely where is your startup in terms of stage within the life cycle, and then who would be the most appropriate investor I should be referring to in order to go to the next stage, where probably I will be looking for another kind of investor, etc., etc. So each investor is usually specialized in a specific stage of the life cycle of a company. Now, there's a significant difference between informal investors and funds. First of all, informal investors, they do invest their own money. So the person, they're usually individuals, and the decision whether or not to make an investment is made by the very same person who owns the money that is going to be invested. This is very important. So you don't have to answer to anyone else but yourself about the money that you have decided to invest. That is the first point. Second main relevant point is that you don't have a deadline. Well, of course, you want to make money the sooner the better. That is the, let's say, bread and butter of an investment. The sooner the better. However, you don't have a deadline. So you can hold an investment forever if you wish. There wouldn't be a problem, okay? When it comes to investment funds, now investment funds, first of all, the person who's in charge of making the decision whether or not to run an investment is different with respect to the person that owns the money that is going to be invested. I'll be explaining to you later on how a fund works, but it's pretty straightforward. There are investors, such as banks, funds of funds, institutional investor pension funds, that are giving their money to fund managers. So my job is actually I'm a fund manager. So I don't own 40 millions. The 40 millions that I'm investing through my fund, they're not mine. If I had 40 millions, guys, I would be somewhere else, honestly. But I'm taking the decision, and I'm the only one entitled to take the decision, together, of course, with the investment committee of the fund, whether or not an investment should be done. So that is a significant difference. I'm investing someone else's money. And therefore, investing someone else's money means that I have to comply to the rules of how third parties' money is managed and invested. In Europe, there are rules which are under the umbrella of the Alternative Investment Fund Managers Directive, AIFMD, and then for every country within Europe, there is an authority you have to answer to whenever it comes to any kind of regulation, conflict of interest, anti-money laundering, just to name a couple of them. And that authority in Italy is the central bank, Italian central bank. So we are under the authority, and we have to comply to the Italian central bank and, of course, to the financial policy, etc., etc. And that is pretty much a significant difference with respect to someone, an individual who decides to make an investment on his own. The second point is we don't last forever. As far as we are managing someone else's money, we have to comply to specific regulation of a fund. So a fund itself is regulated by, we call it limited partnership agreement. So it's a document, it's a contract that obliges us to dismiss all our investment within a certain time frame. We can't hold our investment forever. We have a deadline, and usually the deadline with the funds is in the range of 10 years. Not for each single investment, but for the fund as a whole. That is to say, if I make an investment on the 5th year of the fund, that investment cannot be held in portfolio more than 5 years. After 5 years, I have to de-invest with any legal means of the investment, of course. But you see, time frame is pretty much different. And I have an obligation as an investment fund to de-invest my investment. And I have to comply to very, very specific regulations, something informal investors usually do not have to do because it's their own money. So the way investment funds act, behave, and take the decision, as you might imagine, is pretty much different with respect to informal investors. And the boundaries conditions are different. So we can't say the venture capital funds are the one-fit-all tools for financing innovation. It doesn't work. First of all, because they're just focusing on the later stage. And second, is because if you have an investment like in Tesla, I mean, if you were a venture capital fund investing in Tesla early stage, and Tesla was not sold to anyone. Well, of course, now it went through an IPO, so it's a public company. But until it was a private company, unless there was someone else replacing you in the shareholders of Tesla, then you had no chance to exit the company, to de-invest the company. But you as a fund, you had the obligation to de-invest your position in Tesla at least after 10 years, once the fund expired. But if you were a business angel, I would have decided to keep my position forever. Then I had the freedom of doing it. So there are differences. Each tool is different, and if you know the differences, then you might understand why different investors would behave in a different way, because they have different constraints. Now, let's talk a little bit about informal investors. And namely, let's start talking about the 3F+1. 3 Fs usually means family, friends, and fools. You saw the picture over there. Why are we talking about family, friends, and fools? Because let's say you have an idea of a company, okay? You're just there, you just have the idea, nothing more. Maybe you have an alpha prototype, nothing. So someone who's willing to give you money in such a high risk phase of your development is either a relative of yours, is either a friend of yours, or is a fool, someone who is really willing to take a risk in let's say, in a phase of your startup company that is the highest risky of all. Then we have +1. Why did I put +1? Because we should never forget there is another F, and that F is founders. How much money do you put? Your own money in the company. You are the entrepreneur. And sometimes it is not just a matter of money, I mean liquidity, but if you are a founder of a company and you really believe in your idea and you want to bring that idea forward and you work on your idea, how much time you have spent without paying your salary? Because if you don't have money, you don't pay salaries, even yours. So at the end of the day, you are investing your time, which might be significant in a startup company, and that investment worth something. So you should always consider that eventually, we say bootstrapping a startup company, your time is the money that you are investing in the company in order to start it up. Then we talk about business angels. Who are business angels? Business angels are individuals. They are net worth individuals, so people with a significant economic health. They also usually have a peculiarity. That is, their experience, they're usually either managers, former managers, or former successful entrepreneurs in specific industrial fields. So let's say that you have a medtech company. You have prototyped it. You have found a clinical need in the market. And then you meet a gentleman or a lady, and she was, an example, former vice president of Medtronic. And she said, wow, you got it. I mean, I know the cardiological business, and your medical device is exactly what would be needed to solve that specific problem, heart problem. So I will be willing to invest my money because I truly believe, knowing the industry, that your product, if successful, if you go through all clinical trials, etc., that would be a breakthrough in the market. So I trust in you and I trust in your product, and therefore I would make an investment. So the real business angel is someone who has a strong knowledge of the industry your startup company is going to work, might invest few dozens, some hundreds of thousands of euros or dollars, and the real value of having such an experienced manager is because it opens doors. It has the experience, the knowledge of the industry you want to run your company in. So it becomes not just an investor from a financial point of view, but is an investor from a competence point of view. And that is the greatest value business angel can give it to you. Now, that is, say, the ideal business angel. Reality is that usually in these days, business angels are net worth individuals who are willing to, they find pretty much interesting investing in startup companies. They can be very supportive, even from an industrial point of view, and they're usually syndicating their investment. It's not uncommon, and it's getting more and more common, and I would say it's now getting the standard, that business angels are individual clubbing together. We call them investment clubs. They are a syndicate of investors, so they can make even bigger rounds, not just 100,000, but can also invest some hundreds of thousands, not millions. Doing what? They are bundling their financial resources. So let's say you have a dozen of business angels, putting their money together in one company. Usually one of those business angels, one or two, they're called the champions. Those angels that had the best experience in that industry, they understand the business, let's say they are the communication officer with the entrepreneur, etc., but they do represent more people than just one. So still, business angel is an individual investing his own money together with other individuals. And what we are experiencing in the market, especially in the US, but nowadays I would say also in Italy and Europe, is that business angels are moving a little bit more on the A round phase. There are many business angels who are acting more financially, like investment funds, and as a matter of fact, their clauses on investment are very close to those of funds, rather than just acting personally in an earlier stage. But nevertheless, we're talking about individual, wealthy individuals with a sound experience in a specific industry. Last, and that is pretty much a novelty in the world of equity investment, is equity crowdfunding. What is it all about? Now, equity crowdfunding is the opportunity for anyone, even us, to make an investment in a startup company, just bundling all different people, different retailers, retail investors, bundling them together and reaching the threshold of investment required by the company itself. The way it is done, there are actually marketplaces, there are platforms, which are regulated platforms. Italy was the first country in the world regulating equity crowdfunding. And of course, you want to regulate it because on one side, you are enabling retail investors to put their money into startup companies. So it's a sort of mini stock exchange where actually it collects money, doesn't exchange the money, doesn't exchange shares in a company, but at least collects the money for a startup company through retail investors. So those platforms, web platforms, they're under the authority in Italy of Consob, which is the stock agency. Their business is to, of course, evaluate what has been offered by the business plan of the startup company. They evaluate the soundness of that business. So they basically make sure that all the money that is going to be collected through retail investors, at least while still very risky, is at least managed in an ethical way for a business model that makes sense. And through that platform, you can become a shareholder of a startup company, just putting 500, 100, 1,000, that really depends on the minimum threshold of investment that the company decide would be reasonable for her. Furthermore, in Italy, on example, the Italian regulation requires that every equity crowdfunding campaign has to be subscribed at least by 5% from an institutional investor, a professional investor. So at least all the other investors know that there is a professional investor and institutional investors that underwrites 5% of the capital issued by the company. And that is also further guaranteed for all the other investors that at least the investment is not just a fake one, but is a reasonable one. Equity crowdfunding usually enables you to raise a few hundred thousands. We have recently seen even rounds of several millions. It's interesting because if you have a business model where actually you don't need huge money to go further, but the business model is it's nice, maybe it has a social impact, or it's fancy, and therefore people will be happy to put some little money of theirs in those companies without the need of exiting the company in 10 years, because we are still talking about individuals, so they don't have to comply to the regulation of funds, and still probably that is all the money you need to ensure that your business goes forward. Though, well, equity crowdfunding might be an interesting opportunity to consider whenever moving forward in your business plan. And it's usually something that you do whenever you are approaching the market, you already have entered the market, at least with initial sales, which means you can show to your prospective investors that you have some traction on the market. Guido, you have a question?
Yeah, Nicola, because crowdfund, I was writing in the chat that actually we are talking about equity crowdfunding. That is a type of crowdfunding. That there is the reward-based crowdfunding. There is also lending. There are also lending platforms, and so there are different types, let's say, and families of crowdfunding platforms. And I was just wondering if you have an example of what you might consider, let's say, a benchmark, a flagship for an equity crowdfunding platform that we can also maybe see tonight, and maybe some time for looking at interesting ideas in which investing on. So some platform that you would recommend, because you say these are trustable, these are, well, every platform should be trustable, but that may be more interesting in your opinion.
Well, there are a few platforms in Italy. One of them, an example, is Back24, which was established originally under the umbrella of Il Sole 24 Ore. That was originally where they came from, and they're now becoming an independent crowdfunding platform. And they're working together with the Intesa Sanpaolo group. So it's a very trustable and reliable platform, although they're independent from Intesa, but they're doing several investments under their umbrella. And they're, on example, just released one of the biggest campaign with Innovia, which is, Innovia is a startup factory from Politecnico di Milano and other universities. So just to name something that might be very similar to many of the partners of the InnovaMare project. So something that relies on deep tech and engineering. So you might look to Back24 as one example of crowdfunding platforms.
I'm posting now the link.
Then you're right. I mean, I was talking about equity crowdfunding, although there are other means of crowdfunding. Typically, one example of crowdfunding is the product crowdfunding. That's very common. It can be very helpful. Let's say you have an idea of a new product, you don't have the money to prototype it, or you just have a prototype, but you want to scale up manufacturing, or you just need to cover your working capital, because you have to pay your suppliers while you don't have still the cash coming from your customers. But there are many customers knocking at your door, and they're willing to pay for your product in advance because your product is fancy. So what you do is that you publish your product on a crowdfunding platform, and basically what people will be doing is that they will give you some money in advance, hoping that you will be able to fully deploy your product and eventually deliver the product to them. From a certain perspective, that was actually what Tesla did asking for paying in order to reserve your car. There was a good way of lowering the impact of working capital in their financial structure. And this is something that can be done without touching the equity structure of your company. But this works specifically if you have a B2C product, of course, where many people might purchase your product. It doesn't work for B2B products. Or let's say if you have a social business, you might be working for donations. That is another way of collecting money. So let's say that you have developed something that helps people with disabilities or whatever, and therefore what you say is that, well, if you give me the money, I will be able to fully manufacture or fully deploy this prototype that helps people with, as I said, some disabilities. Therefore, you will collect donation from a crowd, so it's donation-based crowdfunding, and based on those donations, you will have the money required to go through all the development of your project. That's another point. But in this specific presentation, I was referring only to equity crowdfunding, where actually you are trying to collect the money needed for growing your company through a significant number of retail investors. Moving forward, how a venture capital fund works. So we basically introduced who are the various informal investors. Now let's try to have a better understanding of how a fund works. I call venture capital fund works, but actually all funds, closed-end fund is the real terminology, they all work the same way. So we are basically referring to this kind of investors, investment funds, those that are investing third parties' money and have usually a perspective or duration that is limited in time. Now, first of all, when it comes to venture capital, we should always have in mind this is let's say, where we are located. So on one side, we are investing someone else's money. So we have investors like this gentleman here. Let's say this gentleman is the CFO of an insurance company or a pension fund or a fund of fund, and he wants to invest the assets he has under management in different asset classes. And one of the asset classes he chooses is venture capital. So he basically gives the money to this guy here. He's the venture capitalist. The goal of this guy here is to invest the money later on, to take all the decision to invest the money where? In entrepreneurs with brilliant startup companies. Now, once we do invest as venture capitalists our money in entrepreneurs and in startup companies, we are becoming shareholders. So there is one common goal here, and the common goal here is to raise the value of this company to the highest level and ensure that this company is so successful that actually this guy here, a corporation, and we'll see later on why I'm referring to corporation and not to the stock exchange, this guy here is willing to do what? To acquire the startup company. And if this guy here acquires the startup company because that startup company fits within their portfolio of innovation and enables that company to keep its competitive position against his competitors, then he will acquire the company, and then acquiring the company with money will flow back to our investors. So this is basically the chain of value of venture capital. You have financial investors on one side, which are investing their assets into multiple asset classes. One of those asset classes might be venture capital, and venture capitalists are making investment in startup companies in order to let them grow and become attractive for big corporations to acquire them and return the investments later on through the acquisition. So this is I would say, in a nutshell, the business model of a venture capital fund. Now, if you recall, I say, well, you know that venture capital, the model of venture capital of closed-desk fund is basically something that we learn from the sea. And to be precise, the model, the functioning model of a venture fund is very close to the model of the whaling industry in the 18th century. So we are exactly taking the very same entrepreneurial and financial structure that was used for the whaling industry several centuries ago. If you want, you can read the article from The Economist. It's a 2015 article. Before there were tech startups, there was whaling. It's an interesting article. And it basically describes how the whaling industry was structured and how that structure is pretty much the very same structure a venture capital fund has today. Now, let me explain to you how that worked. Now, the whaling industry worked that way. There were whenever you were hunting a whale, that was a very risky business. And we were not just risking our money, people were risking their lives. So the hunting campaign of whales was very long, about month and month on sea, everywhere in the world. But whenever you were able to capture a whale, then through selling the grease, the meat, the bones, everything out of the whale, well, the reward was very, very high. So the way it worked was the ship took sea for the hunting campaign, and then after a month they returned back, if they returned, and basically the reward was based on how many whales they were able to capture. Now, interesting, the people financing the whaling industry, so the whaling industries, they were not owning, let's say, they're not the captains of the boat. Captains on the boat were just, and the crew of the boats were hired on specific purposes every time that a whaling campaign was supposed to start. So whaling investors, whaling entrepreneurs, they were hiring, looking for the right crew, the right captain, in order to get out, hunt the whales, and return with the prize, which is pretty much the way investors are looking for venture capitalists. Venture capitalists are very similar to the captains and the crews of the whaling boats. They don't own the boat, they don't own the tools for hunting. Everything was given by the investors. I mean, in the past, it was by the whaling industrials. In this case, it's the money that comes from our investors. And our investors are selecting the team members. They are selecting the partners. They are deciding whether or not to allocate the money on a specific fund manager just because the people, they trust the people running that fund and not other people. It was exactly like trusting the captain, the officers, and not other captains and officers. And how was rewarded the captain and the crews of a whaling boat? They were rewarded with a percentage of the money that was made by the whale investor, the whale industrialist, later on, once the hunting campaign was over and everything was transformed and the byproducts were basically manufactured and sold in the market. So there is the risk sharing. So the entrepreneur, the whaling entrepreneur, the whaling industrialist was sharing the risk that everything was maybe not successful. In order to mitigate the risk, they were hiring the best captains, and they were incentivizing the captains and the officers with a significant portion on the returns of the hunting campaign. And it was up to the captain, the officer, to make the selection of the crew, and the portion of those returns were also distributed by the crew. So it was namely what we call a limited partnership. So it was a partnership between the crew and the officers of the boat, of the whaling boat, and the investors, namely the whaling industrialists. Was limited, was limited in time, and it was all based on the sharing of the returns out of the whaling campaign. And this is exactly the way a fund works. So you have institutional investors, like pretty much the whaling industrialist. Then you have fund managers. Fund managers are officers of the boat. And what investors are doing is that they are reserving their money for fund managers. So let me make an example. Our fund has 40 millions. Having 40 millions under management doesn't mean that we have a bank account with 40 millions at day zero. But what we have is a contract with our investors that says, anytime that I'm going to make an investment, you are obliged to give me the money up to 40 millions. Once the 40 millions are over, I cannot ask you anymore for money. So I'm collecting the money anytime that I have to make an investment, and I will be distributing the money back anytime that I am de-investing from an asset in our portfolio. Then I take some fees, because I cannot just live on the capital gain. So while I have the strong incentive on the capital gain, which is called carried interest, and we'll discuss about that in a moment, I have some fees which are usually paid in order to pay the salaries to the crew, at least in the initial years, otherwise it won't be possible to start making any operations. But the way a fund works is that you have a manager, and he is the only one entitled to take a decision when and what to make an investment or not, based of course on a contract. So we can't invest anything anywhere. So we make a contract, and that contract specifically says that, we will be making A round, a B round on IoT companies in Europe, or we'll be making seed investments in digital startups in the US, etc., etc. So we define exactly what's going to be the investment strategy, and it's part of our contract, and then we run investments based on that contract. We are the only one taking the decisions when to invest or de-invest, but meanwhile, institutional investors have always the right to check in full transparency that we have operated following the contract that we have signed. So while they are not allowed to take any decisions ex ante, they have the full right to have full transparency of our decisions-making process after we have closed our deals. This is just to avoid that there are influences between the investors and the fund manager. But still, we have to make investments following whatever our we have agreed with our institutional investors. Interesting. This is the scheme of a closed-end fund. So this is the financial tool. It's called closed-end fund. And this works for startups, as if venture capital, works for companies, SMEs or big corporations, and we talk about private equity, buyout fund, works in real estate, works for debt, private debt. So this is a financial tool. It's an asset class that basically the working principles are the same. It's called closed-end fund, but then the assets that each fund will have in their portfolio will be pretty much different depending on the investment strategy. But the financial product itself is exactly the same in terms of the way it works. Before maybe I get into further description of some terminology in the fund, Guido, maybe we can have another 10 minutes break.
We can have. I was looking at the watch, and actually, yes, we can have another break. Just one question, Nicola, that actually was something that you were talking before. That is about even your past experience in Teton Venture. That is a couple of names that maybe you can also leave for us in the chat later about funds that invest specifically in technology transfer. So in a phase that, or actually that they are specialized in investing in deep tech or in technologies, let's say, coming from universities and academias where there is a lot of base research. So if you can leave us also this, information about that kind of funds.
Those funds, from a financial product point of view, there are no differences between the technology transfer fund, a seed fund, a venture capital fund, or a real estate fund. We're still talking about a limited partnership with a time frame and with rules which are all under the umbrella of the AIMFD. So from a financial point of view, in terms of the product itself, it's pretty much the very same product. Although the investment strategy is very different and the way you are engaged in running the investment would be pretty much different. And the skills required to run those investments will be different. That's why I said, anytime that institutional investors decide to underwrite a fund, this is done just because he trusts the experience of the fund manager. So I would never raise a real estate fund. I know nothing about real estate investment. Still, it would be always a closed-end fund like mine, but my experience, my expertise is not at all in running real estate investments. And vice versa, if you have a fund manager who is very successful in real estate investments running a closed-end fund, he will never collect money for making technology transfer investments simply because he doesn't have the expertise to run such a strategy. So the way institutional investors are making their due diligence on which fund to invest is basically based on the experience of the team with respect to the investment strategy, and ideally their previous track record, of course, in terms of good results on previous funds. But the tool itself, which is a closed-end fund, is exactly the same from tech transfer to real estate. In Italy, as of today, there are 5 technology transfer funds which have been launched under the umbrella of the ITTech platform. So it's ours. We have been the first. Then there is a biotech fund. It's called Innovate and works primarily on rare disease. A second fund works on sustainable solutions. It's Progress TT, managed by ITTech. Then there is a fourth fund that works primarily on digital technologies around Polytechnic of Milan. It's 360, Policy 360, managed by 360 Capital Partners. And then last but not least, we have a fund that works on new materials, primarily as is named Eureka. Those are the 5 tech transfer funds which have been launched in Italy in the last 4 years.
Okay, so maybe after the break, if you can provide just a copy of a link. For example, I found the one of Euroca Venture, but maybe also the others can be interesting to give a look, let's say, to give a look.
Yeah, although not many of them you will find public information about what they're doing. It's very much, some of them like 360, Poly 360, I was not even able to understand while being, let's say, an insider. I have very limited information. And the other one where limited informations are available is a Innovate fund. More information are available on Progress TT, managed by ITTech.
Okay. Perfect. Thank you so much, Nicola, and see you in 10 minutes at 11:30.
Okay. 11:30. See you soon.
Ciao.
Ciao. You change your pullover.
No, it's always the same. It's always the same. Okay. So I think, Nicola, that for many people in the scientific world, these are not really easy, let's say, concepts to understand. But it is important to understand how also the financial world, works. I'm just assuming because I don't have evidence, but sometimes it is difficult also for me that I teach management, so at the end it's not so distant from what you teach, also to acquire the appropriate vocabulary and to learn all the mechanisms that are behind, let's say, the investments procedures used by venture capitalists and Francesca say, I confirm it is difficult to understand who is the institutional investor that is providing the money to the fund manager, the things that is managing the fund. Let's say that the fund manager is actually imagine to have your parents asking, Francesca, please invest our savings, our money, and actually you find yourself in the position to become a fund manager and have to select what are the most appropriate investments that in which to invest the money that someone gave you, of course. And part of your remuneration will be linked to your ability to select the most appropriate investments of the money that your parents, relatives, and cousins gave you to invest. And so maybe you may decide to go in Back to Work 24, the platform founded originally by Sole 24 Ore, and to found, for example, to invest part of the money in interesting startups, and then in 10 years creating an overall return of your investment of, let's say, 500%, and then give back part of the investments of the returns to the original investments, or actually give them back all, but keeping for you a part that is also part of your remuneration. So the more good you were, the more you also you earn. But if in theory it is simple, actually then in the details it is more, let's say, complicated.
It is, although that's why I like the article on The Economist. Very interesting, because at the end of the day, there's one rule I understood working in the financial sector for a while, but this is not my primary background, that in the world of finance, things must be kept simple. They might seem overcomplicated just because we have our own terminology, okay? But it's a matter of terminology once you haven't understood it. But the basic concept, the basic principle are really ground to earth. And think about a closed-end fund really as for the whaling industry. So there's someone running a ship, and that someone doesn't own the ship, okay? The ship was given to him with the tools or whatever by someone else. And that someone else wants to earn money selling whales. But of course, as far as you're running the risk of hunting and you might be losing even your life, then the reward for you is that you will be sharing the risk and the reward. So I might lose the boat and whatever I have invested it, you might be losing your reputation as an investor or your life as a captain on the boat. But if everything goes properly, then we share the returns out of the hunting campaign. Those are the basic principles. And the other basic principle is alignment of interest. Make sure that we're all on the same boat. We all have the very same objective. Nothing is worse in finance than have this alignment of interest. whenever you had this alignment of interest, which in other terms might be a conflict of interest, then probably you will not be doing what your investors would like you to do. Okay, but that's it. Then you can have complicated. Sometimes contracts are complicated simply because they are not written in plain language. But if you take a contract, you understand it, and you write as a flowchart, because at the end of the day, a contract is a flowchart. Believe me, this is far more easier to be understood. The problem why contracts are so complicated is because they're written in not plain language, and they are sometimes complicated because they are not referring, the clauses are not properly referring each other. But once it's like a puzzle. Once you find the puzzle and you write it, as I said, as a flowchart, it's really straightforward. So I know it's complicated, it might sound complicated, but at the end of the day, it's much easier than science because there's no science behind it. Just to give your life a little bit more complicated. This is pretty much the simple terminology that you see in a fund. And just let me introduce some concepts in terms of alignment of interest, etc. Whenever you have a fund, an example, I mentioned to you, we share the risk and therefore we share the reward. How do we share the reward? This is what we call carried interest, okay? Carried interest, which is the main reward every venture capital fund manager would have, is the percentage of the total return of the fund that would be given to the fund manager if and only if total return are exceeding a certain threshold, which is called hurdle rate. So if I might, so let's say this is what goes to the percentage that goes to the venture capitalist, okay? It's like, and this is the total return of the fund, okay? So unless the total return of the fund reaches this threshold, that is the hurdle rate, the VC manager takes nothing. Then it starts taking, sorry, it's not a percentage, but it takes something which is usually in the range of 20%, okay? Of total returns. This is the way it works. So if the total return of the fund is lower than the hurdle rate, we take nothing. If it exceeds the hurdle rate, which is usually, this is a compound interest rate. So every year you have 8% of what has been invested in the previous year. So it's a compound interest rate. So at the end of the fund, we say how much money was returned, and whatever came out of that money, if we exceeded this target return, we take 20%. Otherwise, we take nothing. So our goal is to be as good as possible in returning more than it was invested in the fund. The other point is the management fees. This is very important. Now, I told you that fund lasts for 10 years, okay? So this is the life of the fund. However, the fund is usually split into two main sections. The first part of the life and the second part of the life. The first part is called the investment period. And it usually lasts for 5 years. What is the investment period? As far as the fund has a lifetime and then expires, it makes no sense to make a new investment in year 9 because in 1 year, there are no chances for you to day invest and create value. So it's very common for a fund to say, you can invest, you can make new investments only during the first 5 years. After the first 5 years, your only job is to day invest whatever you have invested in. Interesting, we do have management fees, so we have to pay our salaries for the first 5 years, okay? So what the investors are paying us is to pay salaries, operation, etc. And then they told us, okay, it's fine, I will give you a percentage. So let's say we have a 50 million funds. So the fund agreement, the limited partnership agreement, which is the contract between us and the investor, says 2% of those 50 millions, which is basically 1 million every year, is paid to the fund manager for salaries, the office, traveling, for everything, from doing our job. And this is granted. So for 5 years, we know that every year we will have 2% of those 50 millions. But investors are not stupid. They say, okay, I will be paying your fees for the first 5 years, but after the first 5 years, I'm not paying you based on the 50 millions. Because if you have made no investments, it makes no sense for you to keep on paying you any management fees because you have nothing to manage. So I will be paying you management fees after the investment period based on what? Not anymore based on the total amount of money that I promised you, but just based on the value of the assets you have invested in. So let's say we make several investments and the value of those investments is 40 millions. They pay our management fees based on those 40 millions. And interesting, anytime that we either write off, so we dismiss one portfolio company, the value of the asset under management lowers because we have to subtract the value of the company that exited the fund. So what happens to management fees? It is that they are stable the first 5 years and then they get, usually the way they do is that there is a gap here and then they get lower. Luckily, at this point of time, we can run another fund. We are able to launch another fund and maybe we might have the commissions on the second fund because the commission on the first fund will not anymore be covering all the costs related to running the fund. Why is that relevant? Because this on one side ensures that we are committed to make investments on the first 5 years and we must make good investments, otherwise we are not eligible for the carried interest if we don't make good investments. And meanwhile, our salary won't be paid anymore after 5 years if we are not making investments at all. But as far as this hurdle rate is also pretty much linked to the time frame of the investment. So the shorter is the time frame for the investment, this threshold gets lower because it's a compound rate. For a fund manager, the sooner the exit takes place, the better it is. So what a fund manager is, the incentive of a fund manager is to make many investments at the beginning and exit as soon as possible. The structure of a fund is made in such a way that we have to make many investments at the beginning and shorter as much as possible the time frame for an exit. This is very important because with respect to an informal investor, we have a strong incentive of they investing, selling a company the sooner. Time for us is really money because the incentive scheme for us is linked to a significant portion of our money. And we know that after 5 years, we won't have any more coverage of our cost by the management fees. And that is the way every closed-end fund works. Another point, as far as time is relevant, and we don't have huge teams. In our case, an example, we are 4.5 people working on the fund. 4.5 people with 22 investments. That's huge. Now, our goal, our primarily scarce resource is our time. The time we can spend analyzing a deal, working on the deal, managing our portfolio companies is very limited because we don't have thousands of people working for us. So this also lets you understand why venture capitalists, fund managers, they prefer to have big funds and make big rounds of investments. Because the time that we spend in closing an investment for 100,000 euros is exactly the same time that you spend in closing investment on 10 millions. And closing investment of 10 millions is much more incentivizing for us than closing investment of 10,000 euros. And the compliance, all the bureaucracy around it, the legal framework is exactly the same, independently from the size of the deal. So again, if you're looking for venture capitalists, don't knock at their door and say, well, you know, if I'm asking less, there will be more chances that they will give me the money. No, the less you ask, the less are the probability that a VC will be happy to make an investment, because we must invest as much as possible of our fund earlier. And the time that we spend in closing investment is exactly the very same time independent from the size of the fund. And that's one example. What is the selection rate? This is an example from our fund. We received, well, it's let's say a month ago, 1,500 requests for an investment. And then you see that actually there is a steep decrease in the number of deals that we have under analysis in the various steps. We have phase 1, which is quick and dirty analysis. Phase 2, we make some work, and phase 3 is where we spend the majority of our time. So our goal is to be as much as possible quick in making the first selection of deals and work only on those deals that make sense. Because time is everything for us, much more than money. So don't be surprised that sometimes venture capitalists are not even answer because we don't have time sometimes to answer to 1,500 requests for investments. And it's very common that the first decision whether to progress or not is just made on a 5 minutes, not even a couple of minutes review of the investment. And believe me, you can easily understand whether something is worth further analysis or not. Quick question. Provide the definition of the grace period. Okay, well, I didn't mention the grace period because it's the grace period is the potential stretch of the lifetime of a fund, where, on example, you ended up at the 10th year, you still have one company in portfolio, and that company, let's say, is under due diligence to be acquired by a potential acquirer. Well, that due diligence won't be over in the time frame of the 10 years. So what you do is that you knock at the door of your investor and say, hey guys, give me another year, because this company might be sold in the next few months. So if you stretch a little bit the time frame of the fund, we will provide an exit, and therefore you will have more money back. Otherwise, as of today, we haven't closed yet the exit time. So it's up to the investors to say, with a majority deliberation, whether they are willing to give us an extra year to the fund, where usually you don't pay any management fees, but it's just an extra year, an extra period of the fund that allows you to keep that asset in portfolio until you finalize the exit process. Did I answer, Carlo, your question? Okay. From a financial point of view, this is the way a fund looks like. So the first years, we just invested the money, okay? And this is the graph representing the cash, the accumulated cash. Now you see, and believe me, this is a very good fund. And okay, so if my fund were performing like this one, I would be very happy. But look at this. This is a fund that actually keeps on, namely, investing money or losing money, at least for the first 5 years. Then we start having some exits and the money is distributed back. But in order to have all the money returned to the investors, this point, which is actually the payback point, our investors have to wait at least 8 years to see all the money back. And only after the 8th year, and probably with a couple of years of the grace period, you will be distributing everything else. So from a financial point of view, this is an asset class that takes out all the money and brings back the money only on the long term with a high risk profile. To give you an idea, if you were investing in a government bond, okay, let's say it's a 10 years government bond, what you would have seen is something like this. You invest in the first year, and then you have interest paid every year. And then on the 10th year, if it's a good government bond, so like, let's say a German, an Italian, or whatever else, the full capital, the full debt will be reimbursed. So this is the profile of an investment on a government bond. So from a cash flow, cumulative cash flow, you see it decreases and then it smoothly gets over, and then you got it there, okay? So you turn everything up here. So this is the profile of a bond. And this is the profile of a venture capital fund, pretty much different to each other. Okay? And this is almost certain. This is absolutely uncertain. So that's why, as from a financial point of view, as asset managers, venture capitalists, while they know they will be running risks, on the other side, we have investors that eventually will always have the choice between investing in a government bond or in a venture capital fund. And they would rather invest in a VC fund if and only if the expected returns are by far exceeding the expected return of a bond, or whether it's a corporate or a government bond. So it's pretty much unfair to say venture capitalists should be running more risks, should be willing to take investments in anything that that looks like a breakthrough innovation, because the reality is we're not investing our money and we have to comply to people who really want to have their money back. So while we know we are running risk, there has to be a very calculated risk. So going forward, let's have a look to the landscape in the investment scenario that there is around the world. So first of all, let's see the distribution of funds invested by phase, by stage of investment. These are the US. In the US, the data are 2019, okay? In the US, 111 billions have been invested in venture capital. In the seed phase, 8 billion, 7%, and 60% went to late stage investment. So a significant majority is invested late stage. Europe, well, Europe is not that so much different. Well, it's different in terms of the overall amount of money invested. We're talking about 37, so it's approximately a third. But the percentage of late stage is very close to the percentage of late stage that we see in the US, and the same works for seed and startup investment. Well, it shouldn't be surprising that in absolute terms, seed investments are so little, because usually you don't invest 100 millions on a seed investment. We'll see later on, but we're talking about something that is less than 1 million. So the number of rounds here are a lot. However, the average amount invested is very, very low with respect to the average amount invested in a late stage. Italy, well, in Italy, in 2019, about 600 millions have been invested by early stage investors. But in this case, in Italy, the percentage of late stage investments is much higher. So there is a concentration of capital that goes more in the late stage rather than, not really in the seed phase, but I would say in the startup phase. So those that are entering the market, this is where there is probably a lack of capital in Italy with respect to the other countries, while still the majority of money gets on later stage investments. Let's see how investments are distributed by size of round. So where the money goes in terms of the size of the round, not the phase of the round. In the US, 71% of the money is invested in rounds exceeding 25 millions. So there is a significant concentration of money only for those companies that require much money. The more money is required, the more money will flow in that specific company. And just a narrow percentage of money goes on small rounds. And this is financially pretty much comprehensible. The more money you invest, later stage, the more chances you have to have a positive return. The scenario is different in Europe. So 71% in the US in round exceeding 25 million, and that percentage fell to 50% if you refer to Europe. The great difference between Europe and the US is here in rounds between 5 to 10 millions, which are about a fifth of overall European rounds, and they are getting less than 10% in the US. So it's interesting to see that between the US and Europe, we have such a difference in the distribution of the size of rounds. Italy is almost aligned to the European landscape. About half of the investment have been addressed in rounds exceeding 25 millions. So not very many rounds. I mean, if you take 600 millions, half of them, which is approximately 300 millions, have been focused on round exceeding 25 millions. So rule of thumb, if basically we cannot talk more than 12 rounds. So 12 investments exceeding 25 millions took half of the overall amount of money which was invested in venture capital in Italy. So just 12 investments. And everything else is almost aligned with the European scenario. Now, the things are getting more interesting if we try to understand how things are going in terms of the average size of round in the different phases. Now, pre-seed and seed, they are usually measured together, so I don't have a split between pre-seed and seed. In the US, we have data separate data for angel investments and seed investments, while in Europe they have been bundled together. The red line is the one you should be looking at, because this is the medium value, the one that has a 50% chances to occur, while the black line, this is the average. And then we have the 25th percentile and the 75th percentile. Now, it's interesting. When the average is so far from the median value, and in some cases exceeds the 75th percentile, that means that we have a significant concentration of money which goes on few rounds, exceeding the overall dimension, but the reality is much different. Or maybe these are the rounds that you read on the newspapers, but this is the reality. And the reality is that in the US, on a seed round, you probably will have $700,000, which is not very far from Europe. Again, Europe, you see that the average is far from the median. Interesting, the angel rounds are much higher than the seed rounds, and they have grown significantly from 2014 onwards. Why is that so? My hypothesis is that as far as business angels are now moving together in syndication, and they are now acting more like venture capitalists rather than originally business angels, they are now moving later stage. They are now making A rounds more than seed rounds. And that biases a little bit the size of rounds. So they're still counted in seed, but the reality is that many of rounds which have been done by business angels should be referring to A round and not to seed round. And that explains why the overall dimension of round increased significantly in the US in the last years. So this is for pre-seed and seed. So interesting. It's not true that if you have a seed round in the US, you will be raising millions. And if you were in Europe, you had peanuts. Europe and the US are pretty much aligned in terms of size of round early stage. If you go to the A round, again, look at the median and look at the average. The average is still very high and exceeds the 75th percentile. Now, so again, we have a significant concentration of money. The distribution of money is dramatically asymmetric. In Europe, it's even higher. So the average is very far from the median value. But look at the median value. So maybe on the newspaper, you might read that this company raised 5 million, but the reality is that you can target 5 million in the US and 2 million in Europe for an A round. And this is the reality, not the 14 million here or the, I don't know, 7 million here. Those are the exemptions, not the reality. The reality is here, at least for the A round. And when it comes to later stage rounds, again, significant asymmetry in our distribution. This is even stretched. It's even more asymmetrical than the previous rounds. But the reality is here. And the reality tells me that, no, sorry, what happened? I'm sorry, I will be sharing.
While you were, making notes in the slide, Nicola, I was thinking that in later phases, the gap, let's say, between the two, between the European system and the American system becomes, I would say, more clear. So it's clear that the US invests more. But there is also a matter of number of venture capitalists, right? So at the end, we have more venture capitalists per inhabitants working in the US than in Europe, and that makes, let's say, the system more fluid, let's say, than the ones in Europe, or not? Is it just an impression?
Well, usually venture capital should be measured not the number of venture capitalists per inhabitants, but it's the overall amount of investment per GDP. So okay. It's the ratio between the amount invested, and if you just take that ratio, well, the ratio is higher in the US than in Europe, definitely, but not that so much higher. And in some countries in Europe, the ratio is higher than in the US. Okay, so of course we have to compare 111 billions with 37 billions, but also we have to weight it against the GDP, which is definitely comparable. I mean, the US and the European GDP, EU 27 are comparable, but so there's not a 3 times difference between the GDP of the US and GDP of the EU 27, while historically it's a more mature business industry in the US, definitely. Has been historically even more speculative. And the reason why I said it's going to be more speculative will be pretty much clear later when I'll be showing you some figures regarding the exit values that we see in the US and in Europe. But I wouldn't stress those the differences in a significant way that is usually stressed by the normal means of communication. So Europe is definitely catching up in terms of the amount of the maturity of our industry. The point is, we should not consider the VC industry as the only industry that allows financing of innovation. But as we have noticed before, there are many tools which should be considered altogether. And the differences between Europe and the US are not that so significant in terms of availability of money and size of rounds. The other point that I want to show you is the time frame. Now, the Italian data, I calculated them based on 2019 rounds, but they're less accurate for several reasons. That just the way data were collected. So take them as a reference, but not, let's say, as scientifically proven data. But as you see, the time frame, this is the medium time between the foundation of the company. So here the company is established. So it's year 0 for the company. And this is how the number of years before the company gets funded on a seed A round or a later stage round. So again, this is interesting. We always said that raising money in the US is much easier than raising money in Europe early stage, but this is not true. Even in the US, people have to wait, entrepreneurs have to wait for about 2.5 years before they got the seed investment, which is exactly the very same time frame that we notice in Europe. Forget about Italy, as I said, because it's not really reliable. Then usually once you get a seed fund, then the time frame between the seed fund and the A round is about 1 year. And again, as you see, that's pretty much aligned. Europe and the US, they are pretty much aligned. And they're also pretty much aligned when it comes to later stage. Now, later stage is, of course, including B, C, D, all rounds. Okay, so usually the B round will be here, I don't know, and the C round here, whatever else, but nevertheless, the medium time frame of a later stage round is 8.1 years after the establishment of the company in the US and 7.5 years in Europe. It's a very long time frame. So you scale up, you have funds for scaling up after your company was already in business for a while. So those graphs or those ideas, those, I would say, stories where you see dramatic growth of companies, startup companies in 3 years in the US, they're not true. They do not exist. The reality is that even VC investments require a long time frame before they really get the pace, the right pace, and increase their value and scale up. So do expect, and we talked previously about Tesla, SpaceX, but even startup companies, they take a long time before scaling up. And that is exactly the same in the US and in Europe. There is also another player that we should always consider in venture capital, and that player is corporate venture capital. What is corporate venture capital? There are corporations that are making equity investments in early stage startups together with venture capital funds. Corporate venture capital is not a venture capital fund, as I explained to you previously. It's usually a corporation itself with either its own budget or a dedicated fund that decides to take an equity stake in a startup company. Interesting. Almost half of the money invested in venture capital, both in Europe and the US, comes from corporations. It doesn't come from venture capital funds. Although corporate venture capitals, they are investing always in syndication with, let's say, standard funds. And interesting, they are investing in big rounds. This is an example in the US. I don't have that in Europe, but they are investing in big rounds, primarily in big rounds. In terms of the stage of investment, with respect to venture capital, if you recall, that percentage was in the range of 55 to 60%, both in Europe and in the US, more or less. The startup phase is the one where actually the majority of investments from corporate venture capital goes. So once they see a company that's having some traction on the market, this is the time where usually they do make an investment. So why are corporations investing in startup companies? Corporations are investing in startup companies, if you recall yesterday when we introduced the concept of open innovation, because investing in a startup company is a good means for getting closer to that startup company and ideally capture the value of the innovation that startup company is bringing forward. Recently, this is a Boston Consulting Group analysis. Those were the traditional means of innovation, what I call the old innovation tools, so the internal R&D and acquisition. But in the landscape that I introduced to you recently, the deep tech landscape, there are at least 4 other tools corporations are using in order to start working together with startup company, nurturing them and capture the value of their innovation as early as possible and as much as possible. Corporate venture capital is one tool. Then they usually have also what we call the innovation lab. Innovation lab is not a joint lab, but is a mean where a corporation helps startup companies prototyping new products and services. It's like the launch customer. Then they would be incubating those startup companies in their premises. Why should a big corporation incubate a startup company? Because that startup company, you remember, they need facilities, they need knowledge of an industry, and nothing is better than acquiring that knowledge, getting close to that facility, being already establishing in the premises of a corporation. and then accelerating those startup companies. Accelerating means that I partner with the startup company, and I partner with the startup company in letting them accelerate into the market. So the product is already fully developed, it's tested, it works in the market, then I become your business partner and I'm promoting your product in the market. This is a good way for me to capture the value of your innovation and have also better understanding whether the global markets will be ready and will be open to acquire that product. And that happened, an example, in many of our companies. Portfolio company of ours, they are signing agreements, special agreements with big corporations, which I would say they are on the accelerator phase, where actually those big corporations take the rights, have a special agreement taking the rights for the technology, for the product our startup company has developed, and bring them those products in their specific market. In some cases, they ask for exclusivity for their own markets. But on the other side, we know that that company, who is already present all over the world, will boost our sales in that specific market niche. It's a win-win situation for the startup company because it boosts sales, and for the corporation, the established corporation, because it gives an innovative product to be included in their portfolio. So this is basically all about the landscape in terms of venture capital and investments at the global level. I would say, Guido, we take the last break, and then I will be introducing the last topic, which is how we do measure the value of a startup company, of a spin-off company.
Okay, perfect. I think that we can see you back at 12:28, and then we have, let's say, the last half an hour, let's say, with you. Brilliant. Again, sorry again, but at 1 before 5, I will have to go. I'm sorry for that.
No problem at all. No problem at all. Okay, we'll see you in 10 minutes.
Yeah, ciao.
Ciao.
So one day we will spin off our company. Is happening to me in these days, and our value will be measured. And so, in order to determine how much finance also we can get in pre-seed or in one of the different rounds that we have seen together. So, Nicola, in a nutshell, because time is running fast, how do you measure the value of a spin-off company? Do you consider, is there also an element related to the value of the human resources, to the humans related involved in the process that affect the value of a spin-off company, or not? And so the floor is yours for the very last 30 minutes. And again, sorry, I will have to leave 5 minutes before the end of this, let's say, of this meeting. And if anyone has curiosities or anything, I think that we can also transform this last part in a conversation. I don't know how many of you have a thought to spin off a company. Maybe not many, but I have ongoing a research that is still in the data collection process, that is about the relationship between frustration of academics and intention to spin off. So if you want to participate to this research that is in data collection, you are more than willing, and to measure also the level of your frustration with academia, and how this will likely bring you to spin off one day, as it's happening in my case. But Nicola.
Sorry, but is the frustration of an academic something like a psychological support? Is this the way you make data collection, or does it work? Would be nice also to know how you measure the frustration of an academic, but I leave it to you. You are the academic.
There are proxies for doing that. There are proxies.
No, I truly believe it. Okay, so moving forward. So measuring the value of a spin-off company or whatever. Now, there are basically two different areas. On one side, so if you recall, startup companies between the investors, so investors are giving money to the startup company, and the financial performances of a fund or an investor investing in a startup company is basically related to how much money flows into the startup company, how much money is returned from the company to the investor. But the other way around is that the startup, any company, creates value through its processes going on the market. So you have cost and returns, cash out and cash in. So the standard way of measuring the value of the company is basically focusing on this part. So how much does a company values? That of course really depends on the balance and the size of what is, let's say, the cash that gets out of the company and the cash gets in the company, from the company to the market and vice versa. So this is where usually we concentrate in analyzing the value of a company. Now, we should also consider that setting up the value of something, which is actually the price that the market will be willing to pay, it's in economic term the meeting point between the demand and the offer of a good. And honestly, if you think about public companies, there's always the price, basically the market capitalization of the public company is basically the price that the market is willing to pay in order to have shares of that company. And in other terms, there is a demand of shares and an offer of shares. Once the demand of shares and the offer of shares meets the certain price level, that is the price people are willing to pay and people are willing to sell in order to exchange money and shares. And that is the market price, the fair market price. And if you multiply the fair market price of a transaction at a certain point of time of a public company times by the number of shares, you have the total capitalization of that company. This is also true whenever you are deciding to make an investment in a private company, so in a startup company. So how much are you willing to pay for shares in a company? How much you value the shares of the company and what you believe is the appropriate value. And again, this is an equilibrium is the meeting between the demand and the offer. So at the end of the day, whatever sophisticated are the systems evaluating the value of a company per se, reality is there is no value per se. There is always the value that is given by the meeting point between the demand and the offer. That is the fair market value of the company. Anything else which can be calculated without having a transaction is just a value on paper. The only value that counts is the value people are willing to pay in a transaction between someone selling shares and someone purchasing shares. So the question would be, what is the value of an investment? So whenever you have a euro and you decide to invest that euro, you always ask yourself, if I have a euro right now, how many euros will I be expecting to have back, depending on where that euro will be invested? So would I be willing to keep that euro now and not making any investments? Or would I reasonably say, well, I'd rather have 5 euros in 1 year than 1 euro today, or 10 euros in 1 year than 1 euro today? So usually I always make a joke and say, what would be your balance point? If I tell you, you have a choice between having a euro from me now or 10 euros 1 year, what would you choose? 1 euro now or 10 euro in 1 year? And then you see, usually I have different answers and all answers would say, well, it really depends. And as a matter of fact, everyone is taking the decision whether my promise of giving 10 euros in 1 year is reasonable or not, will be maintained or not. Investing in a startup company and determining the fair value of a startup company today is exactly the same process. So this is the startup company today. 5 friends behind a desk. They are willing to become this big corporation, and this is their future. This is what they believe they're going to be. But this is now. So what is the price that I will be paying right now on this tiny team of people just for the promise that they will become a major corporation in God knows how many years, hopefully. So determining the value that I will be willing to pay today in order to, let's say, have an expected return, which is, let's say, just a hope for the future, this is really pretty much close to look into a crystal ball. But this is actually what we have to do whenever, and what we do whenever we are deciding what is the value that we give to a company whenever we close an investment. How much we do value the company, not because per se has a value, because today's those 5 guys around the computer, they value nothing. We all must be clear. The startup company at the idea stage values nothing, 0. We are just valuing the future, the potential future of the company. And here it's really all about different perspective in terms of risk, reward, etc. Corporate finance tells us that there are several methodologies that are used to value a company in an established business. And usually, as I mentioned to you, the way we value a company is just looking to the operational cash flows, primarily the cash flows, because cash is what really counts in finance. So we see whatever gets out of the company, so the cash out, and we try to understand what comes in from the market, cash in or earnings or revenues. And let's say if you will be speaking with any chartered accountant or whatever, they might be telling you that there are at least 2 main systems for evaluating companies. One is multiple. So let's say a company has a certain level of sales. So the company has a turnover, yearly turnover, I don't know, 100 millions, and therefore the value of the company is 2 times the overall turnover. So we say it has a multiple of 2 on sales. Or maybe that company has an EBITDA, which is the profitability of the company is in the range of 10 millions. And therefore, if, let's say, we said the company has sales of 100 and earnings of 10, and we value this company 200, it means that the multiple on sales is 2 and the multiples on profitability is 20. So the value of the company is 20 times EBITDA or twice sales. The other methodology is the discounted cash flow. So we analyze all the cash generation or the cash absorption of the company in usually 5 years, plus, as far as the company usually doesn't last just for 5 years, but we assume that the company will last forever. Then we have also to guess what will be the value not of the first 5 years, but also on all the other years. Now, let's have a look. I mean, usually when we talk about sales, okay, then you can imagine that the multiple sales might be different. You might have a company, so this is an example, this is a company selling 100, but actually they have a smaller cost structure, you see, with respect to this one company. This company has a cost structure of 70 and this company has a cost structure of 50. So you can imagine that this company is much more attractive, having a lower cost structure with respect to this company. So usually the multiple of this company will be higher than the multiple of this company. Or if you look to prospective performances, this company is stable and therefore you're not willing to pay as much as you will be paying for a company that is expecting to grow in the next years. If the company is expecting to grow, you are paying more because you have an expectation that that company will be bigger and the value of the company will be higher in future. So the multiple will be higher. The same works for EBITDA. Again, if you have a smaller cost structure, EBITDA will be higher with respect to highest cost structure, and therefore you, as far as EBITDA, usually pretty much linked to the overall net income of the company, which is the money that potentially can go to the shareholders. This company is by far more attractive than this one, and therefore the multiple will be higher. And the same works for prospective performances. If I'm expecting this company to grow from 50 to 90 in EBITDA, this is by far more attractive than this company where actually the growth expectations are none. And therefore, I will be willing to pay more in terms of multiples than the other company. Interesting, when it comes to multipliers, well, look at this. This is the graph showing the different level of multipliers on EBITDA by industry, because industries, they do have different cost structures. Oil and gas or automotive, they have high cost, very heavy cost structure, okay? And therefore, the multiples are limited. And honestly, the perspective of growth in oil and gas and automotive are almost zero. Those are very standard, traditional companies. And biotechnology, where the expectation of growth are significantly higher and the cost structure is different, well, in this case, the multiples might be much higher. So depending the industry you are in, then your multiplier will be different. And even within the same industry, if you plot the multiples of company with respect to sales, an example, this is an example from medical devices. Well, all these companies, they are similar one each other. They are working in the same industry, but you see they have different multiples in the same industry. That is to say, if I want to calculate the value of your startup company and I want to use the multiple methodology, which multiple will I be choosing? It's a wild guess. Choosing the right multiple is often a wild guess. Let's move forward and let's say that we focus just on cash flows. So cash, we say in finance, cash is king. So let's analyze the cash flows of a company. Year 1, year 2, year 3. So usually a company takes cash at the beginning and then returns cash later on. Usually what we say is that we discount the cash flow. Discounting cash flow means a very simple thing. Remember the previous slide said, how much money will I expect in future out of €1 today? So would I prefer to have €1 today or 10 euros in 1 year? That means that the future value, so 10 euros tomorrow, are equal to €1 today, or 5 euros tomorrow are equal to €1 today. That is your decision point. And you decide whether €1 today is equal to 5 euros tomorrow, depending on the risk that those 5 euros will be there tomorrow. Okay? So the discount rate basically tells you how much you would expect in 1 year to your euro. Would you rather have €1 if, let's say, we have a 10% discount rate? It means that you expect to have €1.1 in 1 year with respect to €1 today. If it's 35%, it means that your decision, your let's say point of balance is between €1 today and 1.35 euros in 1 year time. The higher the discount rate, the higher is your perception of risk. To give you an idea, usually in venture capital, we are in the range of, in seed investment, at 70%. So every euro today must return at least €1.7 in 1 year. Or the next year, because it's a compound rate, so this is 1.7, and the second year it will be 1.7 at the power of 2. The third year will be 1.7 at the power of 3. Okay, it's compound because every year we are expecting to see an increase, which is by 70% of what of the previous term. Plus, and this is the methodology, you can calculate also the value of the company. We call it the perpetuity. That is the value of the company after the 5th year. Now, I made this example, and this is a real example out of a business plan, to show you what, that if you use this methodology, which is the most common methodology, and everybody wants to use this, what you end up is that, first of all, depending on the discount rate, you have a different value. So this company, if you use a 10% discount rate, the value is 55. If you use a 35% discount rate, the value is 11. So there is a ratio of 5 here, just because my perception of risk is different, okay? And furthermore, out of those 11 million, 30 millions refer to what? To the value of the company after the 5th year, from the 6th year onwards, which is totally a wild guess. We don't even know whether these cash flows are reliable. How in hell can we value the company based on the expectation from the 6th year onward? And look at this. This value is higher than the total value that we give to the company, which means that on the first 5 years, the value will be less than 0. It's negative. So this methodology tells you that if I take a startup company, not only the startup company values 0 today, but most probably will have a negative value, if I'm just referring to this methodology, because the value I'm giving to this company just relies on wild guesses on the 6th year onwards. Venture capital and private equity, we have guidelines, valuation guidelines. So there are several methodologies, and those methodologies are very well described in these guidelines, which are shareable and you can download them. Now, interesting, they tell me that the multiple methodology is appropriate in established businesses. I can't use this methodology for a startup company. And as far as discounted cash flow is concerned, they tell me there is a significant risk in utilizing this valuation technique because totally unreliable. But unfortunately, those are the two reference methodologies for valuing established businesses, which means, in other terms, you can never evaluate a startup company with appropriate methodology. There is no methodology that gives you the right value of a company, which is a startup one. So let's go back to our point. We know for sure that today the value of a startup company is 0, nothing. You value absolutely nothing, because it's all about expecting what you will be valuing in the next years. So what really counts for an investor is to understand from a qualitative point of view, first of all, if the business plan is sound, is reliable, how much is it reliable, and what is the risk associated to that business plan. So we want to understand what is the risk that we will be running of losing our money based on the key industrial assumptions on the business plan. So what we do, we actually have a process, and the process starts with analyzing the business hypothesis. First step, we make an evaluation of the risk. We have our own methodology, and this risk tells me how much money I'm expecting in return. What is my famous ratio between €1 today and €10 tomorrow? So I'm trying to value in the company based on what? Not based on the value of the company today, but based on the value that this company might give to my fund whenever I will be exiting the company. So what we are doing in VC is that actually we try to make a wild guess of how much will be the value of the company when the company will be exited. We have our target internal return rate, which is the famous, you remember, 35%, the discount rate, okay? So if I take this, let's say, discount rate, and I am actualizing that 83%, 83 million in year 6 are equal to 24 million in year 2 and 15 million in year 1. That is the actual value using the 35% discount rate of 83 millions. I will calculate these 83 millions with standard methodologies. Usually we use multipliers. And the assumption is that at the 6th year, the company will be an established company, and therefore I can more or less use a multiplier. So that if the company now values 15 million and I have to make an investment of 3 millions, my shares in the company will be 3/15, which is more or less 1/5, that 19.6%. Then time passes by, you ask me another 3 million to be invested, and I will have an extra 3/24, which is 1/8. So if I sum 1/8, which is almost close to 10%, then I grew from 96% to 29.6%, which will be the cumulative shares of the company that I will be taking. And then 29.6% gives me 23 million as expected exit value. And look at this, that 23 millions with respect to 3 millions cash out of year 1, 3 million cash out year 2 are equal to an investment with an expected return year on year of 35%. So the approach that investors, venture capitalists are doing whenever we value a company is not at all the methodology that says how much the company values now, because a startup company values nothing. If you take any corporate finance methodology, the value of the company will be simply 0. So that's why people not used to make investments in startup companies, such as your company, because they are not able, they don't know how to value the future value of the company. While the job of venture capital is to make a wild assumption of what will be the value of exiting the company, and then making an assumption of how much will be the risk that we run, and therefore the expected return on that specific company. We then calculate how much the company values for us today, which is not the real value of the company, but is the value for the buyer, for the investor today. It's not an absolute value, but if you recall, the concept of absolute doesn't exist. There is only one market price, and the market price exists whenever the demand and the offer of a good, in this specific case, the shares of the company, are meeting together with the price. And this is all. It's just meeting our expectations and the desire of the entrepreneur.
Nicola, sorry to jump in, but this is all also for us because it is one. And before going to the other meeting, I wanted to say hello and thank you for, the valuable information that you provided us. So basically, to sum up, I would say that we should remember that whenever, our startup that is no longer a startup, but actually a company is evaluated from a venture capitalist that is already a company in the market, and after some years maybe you are looking for an investment, we will be evaluated according to 3 possible criteria. That is, one is how much revenue we are creating, actually how much profits we are generating. The third is how much cash we are generating, because sometimes companies can create profits, but they don't create cash. It's difficult to explain this to maybe a person that is not a financial background or management background, but it can be that companies are able to create profits, but not so good in creating also cash, let's say. And then on the let's say riskiness of the investments that will translate, let's say, in how much we can expect in return on these investments. And if I can actually, and then I really have to go. I was just asking before I had to take also another call, if you saw the question that was raised by Fausto several minutes ago, but that I missed at the moment. But then I had to take a phone call and I missed 5 minutes of our meeting. That is, you were talking about, Fausto, correct me if I'm wrong, evaluating a company, and you asked how can we increase the perceived value of our product and this the actual value of something to pay. Fausto, I don't know if you can maybe provide.
Yeah, sure. I can fastly. It was about the slide where you had the demanded good price and how the market will pay the value that the product has, right? And sometimes maybe the product actually has more value than what people are willing to pay, because people are not perceiving the real product or the real value of that product. So of course it will be through marketing, but how can we show to the customer that our product is actually valuing more and maybe increase that price?
Okay, well, you know that there is one quote which is always relevant to remember, that is, perception is reality. So the customers, they are always right. Whenever they perceive a value and they give a certain price, which is actually their willingness to pay, this is their perception and this is the reality you have to face. Now, there are several means for increasing the value of a product, and that's why I said at the very beginning, don't stick to technology. Customers not care about technology, they care about the overall customer experience. So the best way for you to increase the value of your product, and therefore the willingness to pay from customers, is to thoughtfully exploit the customer experience and design a customer experience which is a winning one. And there are methodologies in doing this, and that is as far as product and services are concerned, which is not that so far different from the value of a company, especially if it's a startup company. If you recall when I say you always have to invest in marketing in order not to give the impression that you're a startup company. Now, nothing was more interesting to me than listening to some big corporations visiting a startup company of ours and telling me, well, this is a real company, it's not a startup company. Because the office was a real office, there was a good team there, and that company was in 1 year completely changed its face. From 3 people in a lab, it became 35 people in a nice headquarters, divided with a nice organization, processes, etc. That was the impression, okay? And that impression was very relevant, because in the eyes of, that was both customers and investors, they understood that they were not just dealing with something that probably was a fancy startup, but something that was now a real company. So again, raising the impression means you have to invest in your brand, in your image, make it the proper communication.
Sure.
This is all about, and that's why you have to make marketing investments since the very beginning. It's by far more important than just working around technology. And it's very common in some cases, and this is very common for engineers, we over-engineer our product. We believe that our customer will be happy to have fantastic performances. But just think about Excel. Take an Excel sheet. How many of you know all the hidden formulas of Excel? Excel has tremendous functionalities which are actually, I think, accessible just to 1% of the users. And many people are using Excel just for summing numbers or for making presentations, not at all for Visual Basic or strange formulas or whatever. And I'm pretty sure that the people in Microsoft programming Excel, they will be eager to add further functionalities which will not raise the value of Excel by a penny.
Sure.
Because the majority of users will never recognize that value.
Of course.
So always put yourself, and this is the beauty of having design thinking methodologies early as in the proof of concept phase, because you start putting yourself in the shoe for your customers. And this is mandatory. Always put yourself in the shoes of customers, which also include investors. Investors at the end of the day are from a certain perspective, your customers. So this is important. And perception, as I said, is reality, even for investors. Then, I mean, here I have just the last couple of slides just to show you some figures, and then I think we can all go to lunch. First of all, here I have IPOs, which is the value of startup companies going to becoming public. So they went public into stock exchanges, and those who have been acquired by other corporations. So first of all, the percentage of those acquired by corporation is in the range of 80%, while the percentage of those both in the US and Europe that get listed in public stock exchanges is less than 10%. So again, this goes against all the bedtime stories that you heard. Well, the nice guys were just ringing the bell of NASDAQ. Okay, NASDAQ is there just for a significant minority of startup companies, for 5% of them, while the greatest majority of them are acquired by other corporations. So this is the end of the path. And in terms of value, in Europe, you've got listed, and the market cap, which is usually recognized, is in the range of 50 millions. We're not talking about unicorns. And we're not talking about unicorns in the US. While the US market is pretty much more speculative, but still, we are well below the threshold of 1 billion. We are just in the range of 350 millions for an IPO. So again, unicorns are not there. And the values, which again, remember, they account for 90% of the exit. M&As in the US are in the range of 65 millions value. In Europe, we are in the range of 50 millions, more or less. So again, the world of unicorns, the world of fantastic valuations, of fantastic exit is not the reality. The reality is much more consistent, both in the US and in Europe. And last slide, that is pretty much interesting. And that confirms my hypothesis on probably a significant speculation in recent years. These are the graphs showing for Europe only, okay, so it's not US, Europe, the median values by round, by phases of investment, okay? So how much was the valuation of the company by phases of investment? So it was in 2016, which is the blue line, we had the seed investment with the pre-money of 2.3, which is now 4. After 4 years, we had that increase, almost doubled. And look at this, late stage we moved from 10 to 90, almost doubled again. But look at the exit value. The exit value is going vice versa. It was much higher in 2016 than in 2020. So probably, and this is the word of the acquirer, so how much corporations are willing to pay to have a company. And this is how much venture capital is willing to pay for a startup company. And you see here that the values here in the exit are getting lower, while the values are getting higher. Probably as a matter of the fact, as far as the price is the meeting between demand and offer, that here there is much more money than it should be, and here there is much less money than it should be. The higher the money, the higher the price. The lower the money, the lower the price. So this market, which is the exit market, is a market with less money and with lower willingness to pay than the VC market. And probably with an average, with a median value of 18 millions in exit, you don't even repay the last round. So probably this is a business that is now running through a significant speculation, especially in early stages. This is for the median values, but even if you take the 75th percentile, which is the best performing companies, while still we have, let's say, higher values at the exit than the later stage, but still the trend is getting lower at the exit and getting much higher during the investment phase. So probably here we are again recording some speculation, while here there is a lack of liquidity in the corporate world or willingness to acquire startup company, which is getting lower and lower. That would be all for this conversation. I don't know whether there are some final questions. I know that, I mean, lunchtime is.
There are some questions. If there aren't other questions, I would like to thank you for your interesting presentation. And with the other, we can see at 2 p.m. for the next session.
With Alberto Di Minin.
Exactly.
Enjoy him.
Thank you.
Nice. It was very nice being with you.
Thank you very much.
Thanks, Nicola. Thank you, Lazio.
Thank you. Bye-bye.
Thank you. Thank you.